Yes. Hi guys. Can you please confirm in the chat if the screen is visible and you can hear my voice? Come on, quickly confirm. Okay, great. So in today's session, we are going to cover the remaining chapters of VRM that is mostly related to bonds. In fact, all the chapters that we are going to study today are all related to bonds. And yes, of course, a very good morning to all of you. All the chapters are actually related to bonds: VRM 9, VRM 10, 11, 12, and 13. Okay, so we're going to start with pricing conventions, discounting, and arbitrage, and we'll conclude with modeling non-parallel term structure shifts and hedging. Okay, so that's our agenda, and all these chapters are related to security analysis and interest rate risk. Okay, so without wasting any time, let's start, because these are chapters where where things can get a little bit lengthy. So, and we have to complete everything on time. So let's start the session quickly. Now, so first chapter that we are going to discuss is pricing conventions, discounting, and arbitrage. Now, in this chapter, our idea is to understand how bonds are priced, like in the market, if the bond prices are given, or let's say if the treasury bill prices are given, how these prices are quoted, how we find out the market price, the price at which you will purchase, for example. Okay. Then we will see the pricing of bonds, like how discounting is done, how the value of the bond is derived, and of course, the in the part of in FRM curriculum, we are studying the valuation of bonds on the coupon payment date. So we are assuming that exact number of coupon payment dates are available. Like between the coupon payment dates, bonds are not being valued. And then we'll see arbitrage, like there are arbitrage opportunities, and law of one price actually holds for bonds also. So we'll see how these things work out, and we'll understand this chapter. So let's start. Now, first thing that we're going to understand is treasury bills. We all know treasury bills are instruments issued by government that have maturities less than 1 year. They are meant for short-term funding needs. Okay, and they are defined by the face value of the bond. The first thing is the face value, that is the face amount, the final amount that you will receive at maturity, and the maturity date, like in how many days these bills will be maturing. Okay, so always remember, when in the case of treasury bills, the maturity date is usually given in the number of days or sometimes months. Okay, these are not given in year, because it's obvious to understand. Um, these securities have maturities less than 1 year. Okay, so we can't express it in the years. So usually in the market, you will see that their maturity are shown in number of days, like 90-day treasury bill, 180-day treasury bill, 360-day treasury bill, kind of like that. Okay. Next, holder of the treasury bill actually receives the face value on the maturity date. So let's say there is a treasury bill, the 1 year treasury bill, for the sake of simplicity, as of now. So 1 year treasury bill is there, and it has a face value of 100. So what this treasury bill promises, that you will receive $100 at 1 year from now, not today. So you need to find out what will be the amount that you will have to pay today in order to receive $100 at 1 year from now. So that basically what happens: treasury bills are sold at a discounted price, no coupons are paid, and at maturity you just receive the final amount. So let's say you pay the price $95 today, and at 1 year from now you receive $100. So that actually, if you will see the return, which in the case of bills is calculated on the face value, not on the price not on the price at which the bond was bought or sold, so it will become 5%, the interest rate. However, from the perspective of investors, we always try to calculate the interest rate on the price that we have paid. So there can be slight difference, but as a convention, I would say you can always remember that usually for treasury bills, interest rate or the quoted price that is given is actually calculated on the face value of the bond, not on the uh, price of the bond. Okay. Now let's move forward and let's see how these are priced. So if we assume that Q is the quoted price of the treasury bill and C is the cash price, so you see there is a difference between quoted price and cash price. Quoted price is the price that you see on the website of whoever dealer, bank, or trader that you are dealing with, okay, or broker that you are dealing with. Okay, and C is the price that you finally end up paying. Okay, so there is a difference between these two, and there are certain ways, certain conventions that are followed when these dealer banks are trying to quote the price of bills specifically. Okay, and always remember, cash price would uh, uh, it, cash price is the price that you will have to pay in order to receive the face value. Okay, each will have a face value of 100. So by convention, the face value is assumed to be $100 in the US market. Now, the relationship between the cash price and quoted price is given as Q, that is the quoted price, is equals to 360 by N, where 360, actually the day count convention for treasury bills is actual upon 360. Okay, so there are 3 day count conventions. We all know that. First one is actual upon actual, that is actual number of days from today to the next coupon payment date, and total number of days in the reference period. Okay, so that's actual upon actual. Then you have 30 upon 360, which is the most basic day count convention, and it is mostly used for the corporate bonds. Actual upon actual is used for treasury bonds. Okay. And then you have actual upon 360, which means you will take the actual number of days to calculate the cash price, that is from today to the maturity of the bill. And in a year, it is assumed that there are 360 days in a year. Okay, so Q is given by this formula, that is Q equals to 360 by N times 100 minus C, where C is the, I would say, cash price of the bond. Okay, C is the cash price of the bond. Now, if you know the quoted price, which is usually given in the market and in the form of interest rate, actually, that okay, whatever the interest rate on a treasury bill is actually shown as the quoted price. So if let's say quoted price is given as 5, I'm not talking about bid ask separation. I'm just taking consider all the quoted price that I'm mentioning as the mid market quote price. Okay, so let's say the quoted price in the market is 5. So that means $5, and we all know that the base face value is $100. Okay, so $5 is the interest earned on this specific security in 1 year period. Okay, now let's say you are purchasing this security, this treasury bill, at 6 months from now. Okay, so now only 6 months are left to maturity. So you will have to find the cash price of the bond. So Q will still be remain 5. Okay, but here your N will get transformed into 180. And then you can do the maths, because there is a second formula also in order to find the cash price. This is 100 minus QN by 360. Okay, where Q is the quoted price, which is the interest rate on the face value of the treasury bill, yearly interest rate. Q is always the yearly interest rate. Remember that. Okay, so if 1 year is exactly left to maturity, then it will be simply 100 minus N. 100 minus Q, that is 100 minus the quoted price. But if it is any time between time 0 and 1 year, if you're making the purchase any time between time 0 and 1 year, then this formula can be applied, where N is the number of days left to maturity from today. Okay, so if let's say 180 days are left to maturity, it will be 100 minus 5 times 180 by 360, that is 0.5. So that becomes $97.5. So today you'll have to pay $97.5, and at 6 months from now, you will receive 100. So in yearly basis, on the face value, if you'll see, you end up earning an interest of $5 only. Okay, on the face value, the interest is being calculated on the face value. From your perspective, if you want to check that what will be the interest earned, so what you can do from the investor's point of view, you can just divide the interest that you have earned, that is $2.5, with the price that you have paid, that is 97.5. So you end up earning 2.56%, not 2.5. Okay, so there is a slight difference, and these are the conventions that are used in the market. So these two formulas, I would say, are actually important from the examination perspective. I would recommend remember only one formula, because you can always do the mathematics, right? You can always transpose things here and there on the LHS and RHS, and you will get to the result. So I would recommend remembering this formula. Okay, remembering this second formula that is given here, that is C equals to 100 minus Qn by 360. And then whatever is given, you can just put it in place and then solve for the missing variable. You will get the answer. Okay. Next, what we have here is an example. And here we have clearly taken that, okay, there is a treasury bill that expires in 90 days. Okay, so 90 days are left to maturity. And we know that quotes are actually the yearly interest rates on the treasury bill. Yearly interest rates earned on the face value, okay, not on the price of the bond. So when I say 1.64 is the bid quote, okay, so it means 1.64% on $100, not on the price that you're paying. Okay, so here the price quotes are given, bid and ask quotes are given to us, 1.64 and 1.63. We can easily calculate the bid price of the bond. Now, what is the bid price? Bid price is the price at which we can sell the security. Okay, or in other words, you can say the market maker or the dealer bank will purchase the security from us. Next, what we have is the ask price. Ask price is the price that the dealer asks, or another way to say the same thing is that it is the price at we investors will purchase the bond. Okay, now there is a clear stark difference. Like if you just look at the quotes, it might seem misleading. Okay, so bid quote is the price that you will sell, and ask is the price at which you will buy. Okay, so clearly it seems like, okay, selling price is high and buying price is low from the point of view of investor I'm talking about. Okay. Now the same thing from the point of view of the dealer bank is actually a bad news. The dealer bank, it gives a sense that, okay, dealer banks are buying at a higher price and selling at a lower price. So they're making a loss, but that's not exactly true. Okay. And it becomes evident the moment you calculate the cash price. Okay. So here you see, when I calculate the cash price, bid cash price, it is 99.59. Okay. So this is the price at which I am selling, investor is selling, or you can say the dealer bank is buying. Okay. And this is the price at which the dealer bank is selling. So clearly the selling price of the bond from the point of view of dealer banks is greater. That selling price is greater than the buying price. So they are definitely making a profit. And here the profit is equals to $0.0025. Okay. So that's their commission, I would say. Okay. Not profit, commission. The bid ask spread. Spread is their commission. Okay. Now, the ask price, as I said, is the price at which investor buys or the market maker sells. These are the conventions that I would recommend always remember. Okay, people get confused the interpretation of bid and ask, because bid, from one point of view, bid price means selling price, and from another point of view, bid price actually means the purchase price. So you need to understand from whose perspective you are seeing it. Okay, and in the examination, you have to be very, very careful if there are questions with where they are asking about bid and ask quotes or prices in general. So you have to be very, very careful that from whose point of view the question is being asked. If it is being asked from the market maker's point of view, then bid price is the purchase and ask price is the sell price. Okay. And if the question is being asked from the investor's point of view, then bid price is the selling price and ask price is the buying price. Okay. So that's the catch here. Always remember. Next, yes, the same thing that I mentioned, that when you see the quotes, bid quote was greater than the ask quote. But when we calculated the prices, the price that we actually end up paying, in that case, we see that bid cash price is actually less than the ask cash price, thereby giving them a commission, the dealers a commission. Okay, the market makers a commission. Now here the mid market price has been calculated, that is 99.59125. And for usually for the calculation purposes, we take the mid market price for doing any kind of calculation unless and until we have purchased it. Okay, and mid market price is nothing but the average of the bid and ask cash prices. Okay, here you can see it is 0.5 times 99.59 plus 99.5925. Basically 0.5 is nothing but 1 by 2. So that's the same as taking the average. Okay, next, treasury bill quote and discount factor. So you see in the properties of interest rate chapter, you guys were studying about spot rates. Okay, so we came to know that, okay, spot rates or zero rates are the interest rate that we will earn over a given period. So if I say 1 year spot rate is 2.5%, so that means I'll end up earning 2.5%. Okay, another way of representing spot rate is discount factors. Okay, especially when we are talking about finding out the present value. So discount factors is just another form of spot rates. And if I know the discount factor, I will also know the spot rate. Or in other words, I can say if I know the spot rate, I can find out the discount factor. They are both closely related. Okay, there is a direct relationship. Now, in those chapters, interest rate chapters that you studied previously, okay, one question might have come to your mind, that how do we find out these spot rates? Are they quoted someplace where we can record it? So yeah, there are places where they are quoted, but it is also possible for us that we can calculate it directly from the market bond and bill prices. Okay, these spot rates can be calculated directly from the bond prices or treasury bill prices that are quoted in the market. Okay, so this can be done, and here we'll see how treasury bills price can be used to find out the discount factors. And the formula is pretty simple. We know that in the case of treasury bills, they are sold at a discount, right? So if let's say I say that, okay, I paid a price of 97.5 for a 6-month period, and I will receive $100 at 1 year from now. So clearly I know the present value and I know the future value, but I don't know the discount factor. Okay, so I can just assume this to be a variable, and I just use this relationship because it has to be equal. PV has to be equal to FV times the discount factor. So spot rates are actually implied from the bond prices or bill prices. That is something that you can consider as a takeaway from this topic. FV can be found as PV by D, or alternatively, I can say D is nothing but PV by FV. Now, this formula that you are seeing right in front of you is true for treasury bills. Okay, is true for treasury bills. In fact, it is true for any bonds also, but their formula takes a different form because there are coupons and there are face value of the bond. Everything has to be considered. Okay, so this is the formula for discount factor. So you know the price of the bond, cash price of the bill, you know the future value, that is face amount of the bill. You just divide the cash price with the future value. you will find the discount factor. Now, once you have the discount factor in FMP 16 chapter, you have studied how to find out discount factor from the spot rates. Okay, so you can use that relationship to find the spot rates then. And if let's say the period was 6 months, so this will become your 6 month spot rate. Okay, but the problem with, I would say, with treasury bill and the problem with finding discount factors with treasury bills is that you can only find discount factors up to 1 year period. You see, bills don't mature, bills don't have maturity greater than 1 year. So beyond 1 year, what to do? So for that, we have bonds. We utilize bonds to find out that, and we'll see how the discount factors are found using bonds in the upcoming slides. Next, let's understand treasury bonds. So treasury bonds are securities which last more than 1 year. They can, in fact, there is a further bifurcation, I would say. Like I would give you an analogy here. Like for example, for polynomials, we have classification, right? If there is one term, we call it monomial. If there is two terms, we call it binomial. If there are three terms, we call it trinomial. If four terms, quadrinomial. And then finally, we call any degree above any polynomial with degree above 4, we simply call it polynomial. But it is also true to say that there are only two categories. If a polynomial, if there is an expression which has only one term, I'll call it monomial. Okay, and everything else will be called polynomial. Poly means more than one. Okay, that's simple meaning of poly. Okay, so the thing is, you can have a broader classification also and a finer classification also. And the same is true for bonds. So for example, in general, you will hear people saying that anything that matures beyond, that has a maturity beyond 1 year, should be considered a bond. But there is a further minor classification as well. And that classification says that if the maturity is from 1 year to 10 years, we call it notes. Okay. And if the maturity is greater than 10 years, then we call it bonds. However, most of the time, the most simple terminology is anything that is maturing beyond 1 year will be called bonds. Okay, but this is just to give you an idea that, okay, if something like treasury note is written, you guys should not get confused. Treasury notes are also bonds. It's just a special category, which is maturity between 1 to 10 years. Okay, from 1 years up to 10 years, and anything beyond 10 years, any security that has a maturity beyond 10 years, bonds. Okay, any bond. Now, if we talk about the features or the defining features, what define treasury bonds? So there are three features that define it. First is the face value, that is the principal amount or par value. Usually, again, for bonds, it's in the US market, it's $100. Then the coupon rate, the interest that will be paid at regular intervals. So that's the coupon rate, which is actually calculated from the face value of the bond. So coupon rate can be 6% paid semi-annually. Okay, so that means every 6% is per annum, and it is paid semi-annually. So it means every 6 months you will be receiving 3% of the face value. That is $3 at 6 months from now, $3 at 1 year from now, and up to maturity at regular 6 month intervals. Third is the time to maturity. That is the maturity date. Like in how many years the bond is actually maturing. Okay, so these are the defining features. Next, let's talk about the pricing of the bond. So in the case of treasury bonds, cash price is basically the quoted price plus the accrued interest. Now, here the quoted price is also called the clean price of the bond. Okay, clean price means in which accrued interest has not been added. Now, I hope that you guys are aware what accrued interest is, okay, and why it has to be added. So I'll not go into that aspect. I'll just show you the formula of calculating the accrued interest, which is the coupon rate times the total number of days from today to the next coupon date and total number of days between the last coupon date and the next coupon date. Okay, these are actual number of days. Okay, that is actual upon actual day count convention is used in the case of treasury bonds. Day count convention should be remembered. Now, here we'll take an example just to understand how the bonds are actually priced. Okay, cash price and bond price. Okay, so here what we have is basically the bid and ask quotes of 3 bonds maturing at 3 different dates. Like we have July 15, 27, July 15, 28, and July 15, 2029. And we will assume a specific date. Okay, so let's say today is 20th August 2023. Okay, now these are the quotes on 20th of August 2023. Okay, I would say 15th of August 2023. Now I want to find out what's the price of these bond. Okay, so let's consider the second bond, which has a coupon of 2.75% per annum. Okay, and these are paid semi-annually. Now, again, a thing that I would like to highlight here is that in the case of US Treasury bonds, the coupons are paid every 6 months. So they do not specifically mention that, okay, 2.75% is paid every 6 months. Okay, they will not write 2.75% per annum paid semi-annually. Sometimes it is possible. Like here, you can see it's simply written as 2.75. But just because we know that US Treasury bonds pay coupons every 6 months, standard US Treasury bonds. So I can safely assume that 2.75 should have to be divided by 2 in order to find out the coupon payments on each of the coupon payment dates. Okay. Now, coupon it will be equal to 1.375% of the face value. That is, face value is usually 100, so it becomes 1.375 directly. Then every 6 months, we are receiving certain payments, that is 15th of July and 15th of January. These are the 2 dates on which I'll receive the payments. Okay. Now the task is to identify the number of days. Okay. So here I have the 15th of July. Then today is 20th of August. Last coupon payment date was 15th of July. Today is 20th of August. And next coupon payment will be on 15th of January. Okay, so I have to find out the accrued interest for this time period from 15th of July to 20th of August. So here, when we do the calculations, we will see that the number of days between 15th of July and 20th of August is 31. Okay, sorry, it has to be 20, not 20th. I think it should be 15th. Okay, it is a mistake. Okay, 15th of August. And the total number of days in the period from 15th of July to 15th of January, that is between the 2 coupon payment dates, is 184 days. Okay, it has been calculated using the date function of the BA2 plus calculator. Next, we calculate the accrued interest. So accrued interest is 1.375, basically coupon times the number of days from the last coupon payment date to today, and the total number of days between the last coupon payment date and the next coupon payment date. And then we find that the number is 0.2317. And finally, the bid price is simply the bid price plus the accrued interest. Okay, that is the price at which market maker will sell. Okay. Sorry, market maker will buy. Market maker will buy. And ask price is the price at which the market maker will sell. Okay. Now here also you can see ask price is greater than the bid price, the cash prices. So clearly market maker has a commission margin here. Okay. Now let's talk about some more detail about the clean price and quoted price. Okay, clean price and cash price. So you see quoted price is also called clean price and cash price is also called the dirty price or market price. Okay. Now, if I assume that the yield to maturity of the bond, so yield we have studied in FMP 16 that what yield is. Okay, yield to maturity of a bond is equal to the coupon rate of the bond. So let's say coupon rate of the bond is 5% per annum and yield of the bond is also 5% per annum. So in that case, the clean price will be equal to the par value. That is, clean price will be equal to $100 exactly. Okay, par value is usually 100. So there is a reason for it. Okay, why this happens. And in the interest rate chapter, this is again revisited. So we'll see at that point of time. However, as a matter of fact, I would say just remember this point, because based on this, you can see questions that, okay, why is the price like this and like that? Okay, or when the price will be equal to the par value. So the basic logic is when the yield to maturity is equal to the coupon rate. Okay. Now, dirty price and clean price have certain, I would say, properties that we will understand. So what happens in the case of dirty price is that dirty price increases over time. Okay, so let's say today is time 0, and every 6 months the bond will be paid, the coupons will be paid. Okay, so what will happen? We will consider just 1 year period. So from today, dirty price and clean price will be equal because there are no coupon payments. No coupon payments are due right now. Okay, 6 months are exactly left. Now, as the days pass, clean price will be a straight line going forward like this. Here you're seeing as the days pass, clean price will stay like this, but dirty price will keep on increasing. Why? Because of the fact that accrued interest is being added again and again and again on the dirty price. And this accrued interest gets added up till the next coupon payment date. Okay, so on the next coupon payment date, let's say market maker was the owner of the bond. Okay, so the market maker receives the coupon payments. Now there is no interest that is accrued, that is pending. Okay, so immediately on that date, on the next coupon payment date, the dirty price and the clean price will become exactly the same. Then again, dirty price will start to increase and then again it will fall back to the clean price. Again increase and fall back to the clean price on the coupon payment dates. Okay, on all the coupon payment dates, you can say dirty price and clean prices are equal. Okay, and on all other dates, dirty price will be different than the clean price of the bond, which is evident from this graph. In fact, the blue curve is dirty price and the green curve is the clean price. Okay, coupon payment dates, dirty price is equal to the clean price, and on other dates, dirty price is greater than the clean price. Okay, now let's see how we calculate the discount factors from coupon bearing bonds. okay, like coupon paying bonds. So because discount factors can be obtained, again, the idea is very simple. You need to take into consideration the present value, future value, and then you can find out the spot rates. Okay, but there is a method which is slightly different. You see here what happens, the method that we use is kind of bootstrap. Okay, so let's say I have been asked to find out 2-year spot rate. Okay, so I cannot directly find it if I'm using bonds. Okay, unless and until the bond is a zero coupon bond. If it is a zero coupon bond, then things are really easy. That previous formula for treasury bills that we have studied can be applied directly. That is PV by FV. Okay, but if we have a coupon bearing bond, okay, if we have to use coupon bearing bonds and find the 2-year spot rate, then you will have to bootstrap. Okay, bootstrap means you cannot find 2-year spot rate using coupon bearing bonds, which are paying by the convention of the curriculum 6 months, every 6 months coupons are being paid, unless and until you know the 6-month spot rate, 1-year spot rate, and 1.5-year spot rate. If you don't know all these 3 spot rates, you cannot calculate the 2-year spot rate using coupon bearing bonds. Okay, so the idea is, first, what I'll do, I'll start with the shortest maturity. So let's say 6 months. First, I'll find what is the 6-month spot rate. The moment I know 6-month spot rate, then I will go for finding out the 1-year spot rate, then 1.5-year spot rate, and then finally 2-year spot rate. So that is something that we will see here in brief detail. So here, let's say these are the prices of the, these are the bonds with certain features, like 4% bond maturing on January 15th, 2024. Then you have 2.75% bond maturing in July 15th. So there is a clear 6-month gap. And here again, the date is wrong. I would say it should have been July 15th. Okay, then only we'll have exact 6 months. So just ignore this. Okay, I'm just cutting it down. I have to ignore it. Okay, just ignore this. Now I have to find out the 6-month spot rate, 1-year spot rate, 1.5-year spot rate, and 2-year spot rate. Using these things, I can easily do it. Okay, so first I'll have to find 6-month spot rate, and for finding out 6-month spot rate, I'll take the bond which is maturing in 6 months from now. That is maturing on January 15th, 2024. Okay, now I'll have to find out what is the future cash flows and what is the dirty price. Here I have been given with the dirty price 101.1747. Okay, this is my dirty price of the bond. That is the price that I paid today. Okay, PV, FV. Concept is very simple. So FV will be how much? $100 that I'll receive on maturity as the face value, and $2 coupon, because it's a 4% per annum semi-annually coupon paying bond. Okay, 4% per annum with semi-annual compounding. Okay, semi-annual coupons are being paid at the rate of 4% per annum. So $2. So my future value becomes 100 plus 2, that is 102. Okay, so here let's find out the discount factor. So first thing is the date. Again, we will have to ignore this date. Okay, it's 15th of July. Okay, it's 15th of July. So this is the price that I paid, and this is the future value that I'm going to receive. First calculation is pretty simple. I can just use the formula PV equals to FV times discount factor. I can find the discount factor to be 0.991909. And using this discount factor, then I can find out the spot rate if I want. Okay. Next, what about 1 year? So now for 1 year, what I already have is that the 6-month spot rate is known. 6-month discount factor is known to us. We have calculated it just now. Okay. In order to find 1 year spot rate, we will use 1 year bond. Okay. So again, here I'll have to just delete it. It's not 20th of August. It's 15th of July. Okay. Now, here I'll see the coupons. I am using the second bond. For second bond, the coupon was 2.75%. Okay. So coupon is 1.375, and the final one coupon is received at 15th of January, and the final face value is 101.375, which is face value plus the final coupon. Okay. Now I have the first discount rate. Okay. So present value is nothing but the price of the bond is nothing but the present value of all the coupons. Okay, all the coupons and all the future payments basically. So one payment is received at 6 months, that will be multiplied with 6-month discount factor, the first coupon, and the final payment will be multiplied with the second coupon. So the final payment will be multiplied with the second discount factor. Then it's just a matter of time. I have already calculated D1 in the last slide. Okay, I'll put in the value of D1. Then this whole equation becomes a linear equation in one variable. I can then just transpose things on the left hand side and right hand side, and then do the calculation to find D2 as 0.980944. So this is what we call bootstrap, one step after one step. Okay, you cannot directly jump to 2 years. Then again, if you have to find for year 1.5, so you will use a 1.5-year bond, their coupons on each of the places, and final face value and plus the coupons. And then you already have D1 and D2 now. You will then find out D3. Always the idea is to make our equation, the price equation, a linear equation in one variable. Okay. And end of the story. Okay. So this is the basic idea how to calculate the discount factors. Now here you will find that first discount factor, that is D1, was 0.99 something, and second discount factor is, that is D2, is 0.98. And clearly D1 is greater than D2. Okay. And on most of the occasions, you will find that the far away period for which I'm calculating the discount factor, let's say I'm calculating discount factor for 5 years, it will be even less than the discount factors for all the periods before it. Okay, now it is easy to understand because we know that usually the interest rate term structures are upward sloping. Okay, that means as the maturity increases, investors require higher interest rates because of the risk premium of the time. Okay, so due to this fact, usually you will see upward sloping term structure, but sometimes we have seen during the time of crisis that the term structure can also become negative, but that's rare scenario, so we are not going to talk about that. Now here you can clearly say based on this that discount factors are a decreasing function of time to maturity. So as the time to maturity increases, the value of discount factor also decreases. Now what is yet another interpretation of discount factors? Okay, in fact, I till now what I have been seeing was that, okay, discount factors are the values that are used to find the present value of the bond or something like that. What is if let's say I want to give it a scientific meaning or a technical definition? Okay, scientific definition. How will I define discount factor? Can anybody tell me in the chat? How will I define a discount factor? Anybody? If you guys want, you can unmute yourself also to tell me the answer. How will I define the discount factor? Sorry. What is a discount factor? The definition. Because you see, once you understand the definition of a discount factor, it becomes easy to understand a lot of things that we are yet to study. Okay, that we will study in the upcoming slides or maybe chapters. Okay, factor that to give us a present value that we use to get the present value. Okay, that's the mathematical explanation. Okay, it's application you are telling me that, okay, discount factors are applied to find out the present value. What actually it means? Okay, I'll tell you, not to worry. So I can say everybody is talking about the same thing. So yeah, let me tell you the definition. So it's more or less you guys are right, I would say, but I wanted more of a finance like definition which you would simplify discount factors, because there is something that we call annuity that we will study. Okay, and that's solely based on discount factor. So definition of discount factor, if I try to define it, I will define it as the amount that I need to invest today. So if it's a 1 year discount factor, okay, so it means that the amount that I need to invest today in order to receive $1 at 1 year from now. Okay, that's how you will say. But yeah, you guys were right to an extent, more or less PV of FV of future value. So you guys were more or less correct. I wanted a precise definition. That's what I was expecting, but not a problem. None of you are wrong. I am telling you once again, I was just asking for some precise definition. So now I hope you guys know that discount factor, if it's a 1 year discount factor, of course, period has to be defined for discount factor to have a meaning. Okay. So a discount factor for a period can be said as the price that I need to pay today so that I receive $1 at the end of the period. Okay. Now, let's move forward and let's see a sample question. So, which is related to replicating bond cash flows. Okay. Now, replicating bond cash flows is something that you have studied in detail, where what we do, we select a bond that, okay, I have this bond. Now, I want to create a portfolio which should consist of other bonds, not the one that I'm considering. Let's say bond one is there, which is a 5-year bond, and it pays a coupon of, let's say, 10%, 10% per annum every 6 months. Okay, semi-annual coupons are paid, and it has certain price. Now I want to replicate its cash flows. The objective is I create a portfolio using bonds which are different from these ones, which are different from bond one. Let's say I use bond 2, 3, and 4. Okay, or let's say even more bonds. Okay, 2, 3, 4, 5, 6, whatever. Okay. So in case of bond cash flow replication, what happens if it's a 2-year bond whose cash flows you want to replicate? You would require 4 bonds. Okay, each with having maturity exactly at 6 months, 1 year, 1.5 year, and 2 years from now. Okay, that's the whole idea. But there are other ways also. So this replication is done in order to find the fair value. Okay, because if I am able to ensure that I have 2 portfolios, one portfolio comprising of bond 1, okay, and another portfolio comprising of, let's say, bond 2, 3, 4, and 5. And let's say the first bond was 2, and both have the same time to maturity. Okay, both portfolios will cease to exist at 2 years from now. And if both these portfolios are providing the same cash flows, that means I'm replicating the cash flows for both the portfolios, then I can say that today the price of these 2 portfolios should be exactly the same. Okay, if they are not, then there is a arbitrage opportunity, and that's why bond cash flow replication is done. Okay, so here I'll take a very simple example. I'll not take the example of bond cash flow replication using only the coupon bearing bonds. In fact, in the exam, if you'll see also, the questions are asked in this way that let's say you have a 1-year 0 coupon bond which is priced at 96.12, and you have a 1-year 10% semi-annual coupon paying bond. So you have 2 bonds under consideration, and the 10% semi-annual coupon paying bond has a price of $106.20. Okay, now I want to find out what should be the price of a 1-year treasury bond that pays coupon of 8% semi-annual. So that means $4 every 6 months is being paid. Okay, I want to find the price of this bond. So here what is happening? I will create a portfolio which consists of 1-year 8% coupon bond. Okay, and second portfolio which consists of 1-year 0 coupon bond and 1-year 10% coupon bond. Okay, and then I'll replicate their cash flows. Okay, I'll replicate the cash flow of this bond, 1-year 8% bond, using this portfolio that I have just created. Okay, replicate means I'll ensure that on each of the coupon payment dates, I receive the same cash flow from both the portfolios. Once this has been established, okay, then I can say that both portfolios should have the same price. Law of arbitrage. Okay, law of one price says that, law of one price says that. So this way I will be able to find the price of the bond. So whatever the price of this portfolio is, portfolio comprising of 1-year 0 coupon bond and 1-year 10% bond. Okay, whatever is the price of this portfolio will be the price of this 8% 1-year bond also. Okay, so that's the whole idea. Now, how do we do it? First, we'll assume that the weight of 0 coupon bond in the portfolio, of course, it has to be have certain weights, right? 0 coupon bond will have some weight, 1-year bond will have some weight. Okay, and then the prices are known. So I can find the value of the portfolio, and value of portfolio will be same as the value of the 8% 1-year bond. Okay, so we assume that W1 is the weight of the 0 coupon bond, W2 is the weight of the coupon paying bond, and now we do the calculations. Okay, so first and foremost, the most easiest way to solve such questions is that you draw a timeline, multiple timelines. Okay, so here I had 3 bonds into consideration, so I drew 3 timelines. Okay, now what I have on the first place is the 0 coupon bond timeline. Okay, I have taken into consideration 6 months also, because there are cash flows at 6 months as well. But for the 0 coupon bond, I simply have written that the cash flow is $0, because it's a 0 coupon bond. It will pay everything at maturity only. At 1 year from now, I have $100, correct? Next, I have created a timeline where I have the 5% 1 year, 10% 1-year bond. Okay, now these two will be used as a portfolio. Okay, and this third bond acts as a second portfolio. Okay, a single bond portfolio. So third bond cash flows are there. Now I need to ensure that portfolio created out of these 2 bonds, first 2 bonds, should provide the same cash flow. That means using this portfolio also, I should receive $4 at 6 months and $104 at maturity. That is at 1 year from now. Using these 2 bonds, I need to do that. How will I do it? Now the thing is easy here, because I have a 0 coupon bond. Okay, so first what I'll do, I'll find the cash flow at 6 months from now. Okay, that I need to ensure that at 6 months, I'm using these 2 bonds and I'm ensuring a cash flow of $4. Okay, so I know that what is the cash flow from bond 0 coupon bond? It's 0. So W1 times 0 plus W2 times 5. Weight of second bond was W2, and its amount was cash flow at 6 months is $5. I need to ensure that combination of these two should provide a cash flow of 4. So that's the relationship that you see here. W1 times 0 plus W2 times 5 equals to 4. So I get the weight. That's the whole idea. In order to find the value of the portfolio, I need to know the weights, right? Unless and until I know the weights, I can't calculate the value of the portfolio. Okay, even if I know the prices. So I get the first weight. Now, since it's a 2-bond portfolio, there are 2 ways to do it. First, the lengthy way. Lengthy way says that I will then find the value of the portfolio. I'll then match the value of the cash flows at maturity or at 1 year from now. Okay, so from these 2 bonds, the cash flows will be W1 times 100 plus W2 times 105. That is weight of first bond times the amount that I'm going to receive, weight of second bond times the amount that I'm going to receive from the second bond. And then this should be equal to $104. Whatever this cash flow is on the LHS, it should be equal to 104. I equate both of them. I find W1 equals to 0.20. An alternative way here would have been to simply exploit the relationship that the sum of weights should always be equal to 1. So W1 plus W2 is equal to 1. I would have saved this calculation. I would have saved myself from this calculation. In the exam, I would say use this. If you have a 2-bond portfolio for bond replication cash flows, okay, for bond cash flow replication. And let me tell you honestly, in the exam, you can find questions like these. Okay, where of course it won't be difficult too much. They will give you 1 0 coupon bond, 1 coupon paying bond. Okay, and then they will ask you to find the price of a third bond, which is again a coupon paying bond with the same maturity. Okay, so here, if I invest, what does it mean? Is that if I invest 80% of my money in bond 2 and 20% of my money in bond 1, okay, I will ensure the same cash flows at all the coupon payment dates. Okay, so now my task is to find the value of this portfolio, which comprises of 0 coupon and 10% 1-year bond. Okay, now here the cash flow will be 0.2 times 96.12 and 0.8 times 106.12, that is 104.18. Okay, so that means the value of this bond should also be equal to 104.18, because this is nothing. The RHS here is nothing but the value of the portfolio comprising of these 2 bonds. Okay, so that's how you will be solving questions like these in the examination as well. Okay, now there is another approach to solve this question, which is actually using the discount factors. Okay, so what you do, you find the discount factors. So I have the 1 year 0 coupon bond. Okay, I can find the discount factor for 1 year easily. If PV equals to FV times the discount factor, I get the discount factor 1 year, 1 year discount factor. Now my task is to find the half year discount factor. So you see, as I said, you have to know something. If you don't know, let's say there are 2 variables, you have to know one of the variables, right? Otherwise you would require two equations to solve the question. Okay, so here then what I do, I have the D1, I have the second bond, 5 times D0.5 plus 105 times D1. Okay, I get the value of D0.5 as 1.0548. Okay, now here, if you'll see carefully, discount factor is actually greater than 1. Okay, 1.05. Let me just verify this calculation just to make sure that it's not wrong. 6, 1, 2. Yes, it is correct. It's correct, 1.05. Okay, so maybe it's a mistake because of the fact that they have not considered it properly. Maybe they just wanted to show the bond cash flow replication using the previous formula, but you can do it. Now here, discount factor being greater than 1 means that you have a negative interest rate here. Okay, you have a negative interest rate. Now, whatever, be it in this question, let's say discount factor is greater than 1, it doesn't matter. We are interested in finding the result, the final answer. The final answer is nothing but 4 times the first discount factor, that is the cash flow, times plus the final cash flow times the final discount factor. So we get 104.18 as the final result. And that's our answer. Okay, so there are 2 ways to solve such questions. One is using the discount factors, another one is using the bond cash flow replication. Okay. Now, let's talk about strips. So strips are basically an acronym used for separate trading of registered interest and principal of securities. Okay, so what does it mean? I'll take a very extensive example here just to make you understand. So let's say I have issued bonds worth $1 million. Okay, so that's the total amount that I am getting from the bond. So a specific bond has a worth of $1 million. Of course, the face value is 100. There is no doubt for the bond, but it's $1 million. Okay, now we'll consider this portfolio altogether. Now what I do, I find, okay, what's the coupon? Okay, so the coupon is 10%. So every 6 months, I'm receiving how much? 50,000, correct? So coupon payments are 50,000 every 6 months and principal is $1 million. And let's say this bond is a 10-year bond. So every 6 months, this portfolio will give me 50,000. And at maturity, I'll get 50,000 plus the principal. So there are somewhere around 20 coupon payments, okay, and 1 principal payments. Now these big institutions, what they do, they actually strip the coupons and principal. That means they will create new securities. Okay, one is called C strip, that will be called C strip, coupon strip, which says that, okay, if I buy the 6-month C strip, that means at 6 months from now, whatever face value I have opted for, I will receive uh, the I will receive the coupons and end of the story. Okay, my security will cease to exist. Okay, if let's say I enter into a contract for a 2-year C strip, that means over the period of 2 years, I'll receive nothing. At 2 years, the coupon that was supposed to be paid at 2 years will be paid to me. End of the story. Okay. So from this 50,000, from this bond portfolio, what they did, they created 20 plus 1. That is 20 coupon strips and 1 principal strip. 20 plus 1, that is 21 strips or 21 unique securities out of a coupon bearing bond. Now, each of these securities can be considered anonymous or I would say analogous to zero coupon bonds. Okay, so if I consider a 5-year coupon strip, so here what is happening, I am receiving nothing for the nothing in between this period 0 to 5 years, but at 5 years I am receiving a coupon. Okay, just the coupon of the bond. I purchased only the coupon. 5-year coupon, I have purchased it. Okay, whatever the present value of that coupon is, I have paid today to the dealer. Okay, at 5-year, the dealer will receive the coupon and I will get that coupon. End of the story. Okay, so what are these? These are all ways of raising the funds. Okay, getting the money. That's all. Okay, so future payments have been sold. All the future payments have been sold. That's what strips actually do. Okay, now strips have different names. They are called TINTs, INTs, C strips, coupon securities. And if we talk about principal securities that have been created, in fact, if let's say you have a single bond, then only one principal security can be created. Okay, but you can calculate, you can create actually, if it's a 10-year bond, the example that I took, I can actually create 20 coupon strips. Okay, principal securities are called TPs, Ps, or P strips. Okay, here T ints means treasury interests, simply interests, or C strips, coupon strips. TPs means treasury principals, or P strips, principal strips. Okay, these are the different names used for strips. Okay, so that's the end of this lecture. Now I'll start with the next session, that is VRM 10. So just give me a minute, I'll share the slide. Okay, so let's now start with the next chapter, that is VRM 10, which is interest rates. Please, guys, can you please keep your webcam off? Magesh, can you please turn off your webcam? Yeah. So let's talk about the next chapter, that is interest rates. Now, this chapter is pretty simple. Only I'll give you the highlights that you need to take from this chapter. And one more thing, you have already studied a lot of things related to this chapter in FMP also, that is book 3. Okay. Chapter 16, properties of interest rates. There you have studied a lot of things: discounting, compounding, yield to maturity, spot rates, forward rates, everything. So I'll not dive into too much detail, but I'll give you an overview of what are the takeaways from this chapter. What all are important from the exam point of view from this chapter. Okay. Let me tell you, trust me, honestly, there are some questions that are asked from this chapter. So And these are easy questions. Okay, they can't be too much difficult. So it's easy marks to grab there in the examination. So let's see the important pointers. First, spot rates. Spot rates are the interest. We all know that we will receive cash just in one future time, just at one future time. And what is the present value? In order to find that, we use the spot rates. Okay, or these are also called the zero coupon interest rates. Okay, or just the zero rates or zeros. Okay, so interest rate that you earn at one future time. Okay, at one future time, only one period, no intermediate periods are considered. So here just the example has been given. Let's say this is the PV that you pay, this is the FV, future value. So the discounting is done, and that discount, that extra income that you are receiving over this period is actually converted into an interest rate. That interest rate is called the spot rate. Okay, so here the spot rate is basically the interest rate that actually equates the present value and the future value. That's the mathematical explanation. Okay, now here we know that for dt, we have read the relationship in the previous chapter that PV equals to FV times dt. Okay, so and dt can be written in this way, where it is 1 by 1 plus zt by 2 raised to the power of 2t, if the spot rates are assumed to be semi-annual compounding, assumed with semi-annual compounding. If it is different, then these things will change. Only the compounding frequency, we have studied it in I think FMP 16, that if my compounding, if the let's say rates are compounded quarterly, so this 2 will get then transformed into 4. Okay, wherever you see 2, here in the denominator and here in the exponent, both the 2's will get transformed into 4 if it's quarterly compounding. If it's monthly, it will become 12 and so on. Okay, now here a simple example has been shown that if I want to find out the spot rate, so here it is given that R is 4% with annual compounding. So basically R is my spot rate here, and this is the relationship to find present value from the future value. If I know the future cash payment, that this is being promised to me, that I'll receive this much, and if current interest rate environment or spot rate for this period is this much, let's say 4%, so what is the price that I need to pay today? Okay, and for the 6-month period, it will be simply FV by 1 plus 0.04 raised to the power of 0.5. Okay, so if it is, let's say, with semi-annual compounding, so it will become 2 times 0.5. Okay, because it has to be like what can I say, my period is 6 months, but the compounding frequency is semi-annual. That means my m is equal to 2. So I just transform the formula, and this is how my present value calculation will look like. Okay, it's just a showcase that I'm giving you. I'm not going into the details. You have already studied it in FMP 16. Okay, now from here we can have an insight that dt can be calculated like this. So in the last chapter, we saw how we find out discount factors using the bond prices, or let's say bill prices. Okay, now once you know the discount factor, you can then utilize this formula to find out the spot rates, or other way around. If you know the spot rates, then you can again utilize this formula to find the discount factors. Okay, alternatively it can be done. Now, if let's say you know that the rates are expressed with continuous compounding, then with the continuous compounding, this is the formula for discount factor, that is e raised to the power of minus r times t, which is the time period. Okay, e raised to the power of r minus r times t, that will give you the discount factor. If let's say you have the discount factor, continuously compounded discount factor, and you want to find out the spot rate, so what you have to do, again, I would say don't remember two different formulas. Just remember this formula and take ln on both the sides. Okay, it will become ln of dt equals to minus of rt times t, minus of r times t. Okay, you can then easily solve it. Okay, now valuing bond using discount factors, we have already seen it, how it is done. We have seen the calculation of discount factors. Now, if I can find discount factors from the bond prices, okay, then I can also find bond prices using the discount factors if I know the discount factors. Okay, so the same thing has been shown here. So here I have the coupons that is being paid, semi-annual coupons, the time is given, face value is given. Now, if I have to find the present value, okay, that is the price of the bond, value of the bond today. So what I'll do, again, it's on the coupon payment date. So here either the bond has actually started selling on date time 0, or this is the last coupon. On this date, the coupon has been paid. A coupon has been paid, so that there is no accrued interest. Okay, so the value of the bond on this case, on the coupon payment date, will be given using this formula for the 2-year bond. Okay, first coupon times the discount factor, first discount factor, plus second coupon times the second discount factor, third times the third, and final coupon plus any final cash flow times the final discount factor. Now the catch here is that you can actually rearrange this formula to arrive at a final result, which is given as C by 2 times AT plus 100 times D2. Okay, now this formula is really important from the exam perspective, I would say, because it's actually a simplification of the bond pricing formula that we have been studying. Okay, and AT is what? AT is the annuity for time period T. So if let's say my time period is 2, okay, so here it should have been written actually 2. So if let's say it is A2, that means it's 2-year annuity. And what 2-year annuity means is that whatever its value is, let's say I find the value to be 1.7, for example. Okay, so I can say that 1.7 is the annuity. Annuity means sum of all the discount factors. So I can say, by if I want to explain annuity, so I can say that if I invest $1.7 today, then I would receive $1 each on $1 each every 6 months, $1 every 6 months for the next 2 years. Okay, that's the definition of annuity. Annuity means recurring payments happening at regular intervals of time, but the time period, the time till which the payments will happen is finite. Okay, it's not infinite. If it's infinite, it has a different name. That's perpetuity. Okay, so annuity, in the exam, you might see that, okay, they will give you the annuity, they will give you the second discount factor, and they'll ask you what's the price of the bond along with the coupon rate. Okay, coupon rate will be given, and they will say what's the price of the bond. So this formula can be applied directly. So if you can just remember this formula, it's not too difficult, again, I would say. But if you remember this formula in the exam, you will get easy marks. Okay, it's pretty easy to calculate. You have AT, you have D2, final discount factor. Just you apply this formula, you get the result. Okay, now there are two ways to value the bond using spot rates. Either one is directly, like you use the spot rates in the fashion that we have done in FMP 16, where we saw finding the value of the bond, or we can use the discount factors using the spot rates and then find the present value. When I use the discount factors, it simply becomes first cash flow times D1, second cash flow times D2, third cash flow times D3, and so on. Okay, here you will have just the expression looks heavy. Both will give you the same results. Okay, there is no difference. Now, valuing bond using forward rates, we all know what forward rates are. So when we are trying to value bonds using forward rate, this is the formula that is used. So in fact, it should be understood that the first period spot rate is same as the first period forward rate. So if I go by the convention of this curriculum, so I know that rates are assumed to be semi-annually compounded. Okay. So what it means is that I have 6-month spot rate. That is the spot rate for the current 6 months, from today to the next 6 months. If I can also say this in a different way. I can say that it is the rate for the period starting at time 0 and ending at 6 months from now. And this definition is very similar to the definition of forward rate, because forward rate also says that period starting at T1 and ending at T2. I have T1, also T2. So by going by this definition, I can say that the 6-month spot rate is same as the 6-month forward rate. Okay, so first forward rate is actually the spot rate only. But from the second onwards, I have 0 to 6 month spot rate, 0 to 6 month forward rate, then 6 to 12 month forward rate. Okay, and this is how you incorporate the forward rates while calculating the bond prices. Okay, this is how you incorporate them. And again, it's really simple to understand that why we are doing like this. For example, if I take the example of this one, second example, second denominator, which is 1 plus f 0.5 by 2 and 1 plus f 1 by 2. Okay, why this? So there is a clear explanation that I can give you here. If let's say I was doing it using the, let's say, just a minute. Okay, yeah. So if let's say I was doing the valuation using the spot rates, so I would have written it like this, that 1 plus z 0.5 by 2 raised to the power of 2t and 1 plus z 1 by 2 raised to the power of 2t. That is, in this case, t is equal to 1 years. So 0.5 and 1 years. I would have written it like this if it was a 1-year coupon paying bond. Now let's just first understand z 0.5. So we know, I have already explained just now that z 0.5 is nothing but f 0.5. Okay, both are the same thing by definition. Now let's talk about the second. So we have studied that Z1 basically is the 1-year spot rate. That means if I invest money today, then I will end up earning Z1. Okay, and let's say Z1 is 4% with annual compounding, or let's say semi-annual compounding, then whatever amount I'll get. Okay, let's say I get an interest of $5, hypothetically. Okay, I get an interest of $5. So again, the law of one price and no arbitrage arguments actually tell us that no matter how you invest your money, at 1 year from now, you will end up earning $5 only. Okay, and if there is a way which will give you more, okay, if there is a way which will give you more or even less, then there will be arbitrage opportunities. Okay, so what you can do, so here another way of creating this same investment is that, okay, first I invest for half an year at the spot rate, 6-month spot rate, or you can say first forward rate, and then at this point of time I reinvest all my money, whatever I get, my principal plus the interest earned for the last 6 months, I reinvest it for the next 6 months at the forward rate. Okay, so here, if let's say I get more money, that means both are providing the same future cash flow. Okay, both are providing the same future. I would say the first alternative is providing a higher future cash flow. So people will start buying this more. Okay, and people will start selling this cash flow. Okay, so again, as I said, buying and selling, so the prices will adjust accordingly, the rates will adjust accordingly, and till the point both the rates, both the ways are providing the same cash flow to us at maturity. Okay, or in other words, you can say both the present value of both the portfolios are same today. If they are not same, then buying one and selling other will give us arbitrage profit, riskless profit. Okay, by going by that argument, I can say even if I invest with this method or this method, I'll receive the same amount. So that means 1 plus Z1 by 2 raised to the power of 2t is equal to first investment, that is 1 plus f 0.5 raised to the power of 2t1 times whatever money I got, all was invested at this rate. Okay, so from there I can say that Z1 by 2 raised to the power of 2 times 1 is nothing but this thing, 1 plus f 0.5 by 2 times 1 plus f1 by 2. Okay, there is a clear explanation in FMP 16. That's why I'm not going into the mathematics. It's really simple to understand. Just consider $100 investment and assume take the two paths, and you will see that, okay, they have to be equal. Otherwise, they like this expression, as per the no arbitrage argument, this 1 plus Z1 by 2 raised to the power of 2 times 1 has to be equal to 1 plus f 0.5 by 2 times 1 plus f1 by 2. Okay, so that's why this expression is used here. In the same way, for 1.5 years, it will simply be the product of f 0.5, f1, and f1.5. Okay, now let's move forward and let's see how we value the bond using par rates. So you see, par rates are the rates that make the bond sell at the par value. Okay, these are the coupon rates, you can say. So currently, usually why par rates are used, one might wonder that what is the use of par rates? I'll tell you the use. So usually when the bonds are issued for the very first time, the objective is to issue it at par value. Okay, that I want to ensure that I will receive, let's say I want to take a loan of $100 million using bonds. So I want to ensure that I'm getting $100 million. Okay, now in order to get $100 million today, what should be the coupon rate that I have to pay? That's how coupon rates are actually decided. So in order to do that, par rates give us the best way. So par rate on that day should be the coupon rate for the bond in order to receive $100 million in its entirety. Otherwise, you will either end up receiving more or less. And of course, it's a matter of fact, like it depends on the company profile, bond rating also. Like it can be, you can get more than what you had expected also. Okay, because the demand for your bond increased when the bond were first issued. Okay, so that can lead to an increase. You end up getting more money. But if you know the par rate and the coupon rate of the bond, then this is the formula that you can use to find the value of the bond. So in the question, again, this is important from the exam point of view, this formula, that if you have the coupon rate of the bond and you know the par rate on that day, okay, the bond is already existing. It's not that the bond is being issued today. Okay, the bond is already existent. Let's say it was issued 1 year ago. Now par rates will keep on changing because the interest rates are changing. Okay, so after 1 year, the coupon will not change. The coupon is fixed now. Okay. So after 1 year, you know the coupon rate of this bond. You know what is the par rate today. And you know what is the annuity value. Then if all these things are known, you can easily calculate the value of the bond using this formula. Okay. Another takeaway from this formula is related to the is actually the relative comparison of the price. Okay, relative, like if coupon rate and par rate are slightly different, then how the price is how the price will fluctuate. Okay, that's the theory aspect of this formula, which is actually exploited in the examination, where what they would say that, okay, it is given to you that right now the par rate is 6%. Okay, today. They will also tell you that coupon rate is 4%. Now the question will be, what can be inferred from this? Will the bond sell at par? Will the bond sell at discount? Or will the bond sell at a premium? Can anybody tell me the answer to this question that I have just asked? Coupon rate is 4%. Okay. Par rate is 6%. I want to know the bond will sell today at par, at premium, or at a discount.
Will be on discount.
It will be on discount. Correct. Who gave this answer?
Will be on discount.
Yes. Sriram, you're right, actually. It will be on discount. Again, it's just a simple exploitation of the formula if you look carefully. Okay. So look at these two parts, 100 and then this. This value formula comprises of two parts, 100 and C minus P by 2 times 80. Okay. Now, this term that you are seeing here, I'll just highlight it once again. This term that you see here, it will be positive or negative depending on which is greater, either C or P. Whatever is greater will decide what this term will be. Will it be positive or negative? And also, value is given as 100 plus this term. Okay, so if this term is negative, value will be less than 100. If this term is positive, value will be greater than 100. And if this term is, let's say 0, then value will be exactly equal to 100. Okay. Now, in the question that I mentioned, I said that par value is 6%, coupon is 4%. So it's 4 minus 6, that is 2, minus 2. So definitely this value becomes negative, and I will say that the value of the bond will be, the bond will be sold at a discount. Okay. In the same way, if coupon rate is greater than par value or par rate of the bond, then I would say that the bond will sell at a premium. And if both are equal, C and P, then this whole expression will become 0 and value is nothing but 100. That means if C is equal to P, bond will sell at par value. That means at $100. So that's the takeaway. That's the theoretical takeaway from this formula. Okay. And that's why I was saying that I'm saying that this formula is also important from the examination perspective. Okay. Now let's move towards the next part. And let's understand what's the properties of spot forward and par rates. Okay. So first is, if the term structure is flat, if you know that the term structure is flat, okay, so all the rates are actually equal. Spot rate, forward rate, par rate, even the yield, everything are same. Okay. So in the question, if you see that it is written the term structure is flat at 4%, for example. Okay. So you can assume that all the rates, if let's say you have to do calculations using spot rates. So be it 1 month spot rate, 1 year spot rate, 1.2 year, 1.5 year, 10 year spot rate, all the spot rates are 4%. Okay. All the forward rates are also 4%. And all the par rates are also 4%. Okay. Next, if the upward sloping term structure, if you have the upward sloping term structure, that means short-term rates are lower than the long-term rates. That's the upward sloping term structure. So as you move ahead in time, the rates are increasing. In that case, you will find that the forward rate will be largest for the upcoming period, T plus delta. Okay. So, and spot rate will be in the middle and par rate will be the lowest. Okay. So if you have upward sloping term structure, par rates are the lowest and forward rates for the next period will be higher. Okay. So let's say spot rate, 6 month spot rate is something. So of course, for the 0 to 6 month spot rate is same as the 0 to 6 month forward rate also. So there is no doubt. But let's talk about the second period. 1 year spot rate is, let's say 6%. Okay. So you will see that the forward rate for the period 6 months to 1 year, that is T plus delta, 6 months to 1 year will be how much? it will be greater than 6%. Okay, maybe 7% or 8%, something like that. Okay, that's the takeaway. Then if you have downward sloping term structure, that means short-term rates are greater than the long-term rates. Sometimes this can also happen. Okay, so in that case, what will be the scenario? Par rate will be the highest and forward rates will be the lowest. Spot rate stays in the middle. Okay, or in other words, you can say during the downward sloping term structure, spot rate will be greater than the forward rate, but less than the par rate. Okay. Now, let's see flattening and steepening of term structure. So flattening occurs first when both the rates go down. Okay, short-term rates as well as the long-term rates, but long-term rates go down by more than what the short-term rate went down. So let's say short-term rates decrease by 10 basis point, but long-term rates decrease by 20 basis point. You will see a flattening of the term structure, and this will be a new term structure. Flattening means the steepness of the structure decreases. Okay, another scenario in which the steep flattening can happen. Okay, one might say that, okay, whenever term structure flattens, the interest rate environment declines, but that's not true actually. Okay, in fact, even when the interest rate environment, what can I say, increases, okay, even when the interest rates, overall interest rate term structure shifts up, then also you can have a flattening, okay, like this. So here, this was the original term structure, the purple line. And now what has happened, short-term rates and long-term rates both went up. But short-term rates went up by more than what the long-term rates went up with. Okay, so here I can say if short-term rates, if short-term rates go up by 15 basis point, long-term rates go up only by, let's say, 7 or 8 basis point. Then also you will see that the steepness decreases. But here interest rate is actually shifting upwards. Okay, so either way you can have the flattening of term structure. Then the steepening of term structure. First, you can have steepening even when the interest rates decline, overall interest rate environment declines, or overall the interest rate environment appreciates. Okay, so here, this is my original term structure that I have. Now what I see that both the rates go down, but short-term rates go down by more amount than the long-term rates. So short-term rates decrease by 20, but long-term rates decrease only by 10. The new curve, orange curve, actually is more steep than the previous one. Although it is lower, but steepness, I'm just talking about the steepness of the curve. Okay, that's what we say when we talk about flattening and steepening. Okay, then finally you can have also a steepening when there are increase. So steepening if short-term rate increase by, let's say, 10 basis point, but long-term rate increase by 20 basis point. Again, you will see the steepening of the interest rate curve. So that's all the takeaway, because these are the aspects that are exploited in the examination. I've told you the important formulas also. First important formula was this one. First important formula was value of the bond using annuity and discount factor. Second was value of the bond using coupon and par rate. In fact, I have told you the theoretical implications also of that formula. So always remember. Third is the flattening and steepening. And of course, it's a theoretical concept. Theory questions can be asked. And fourth is the relationship between the spot, forward, and par rates in different types of interest rate term structures. Okay, when you have flat, upward sloping, or downward sloping. Okay, and let me tell you one thing, that all these curves that I have taken here, original curves, they were all upward sloping. Okay, why I would say upward sloping? Because you can clearly see that short-term rates are lower than the long-term rates. Or in other words, I can say as I move ahead in time, the rates are increasing. Okay, downward sloping term structure will look something like this. Let me show you. Okay, downward sloping term structure will look something like this. Okay, so here short-term rates are higher, long-term rates are lower. Okay, and as we move ahead in time, I end up earning lower and lower interest. Okay, so now effect of maturity on bond prices and returns. So how maturity affects the bond prices and the returns that we are earning. So if everything else is constant and only the time passes, okay, only the time passes, then the value of bond decrease as the maturity increase. Everything else is constant, the interest rate environment, all thing, coupon rate and all. If the maturity increases, the value of the bond actually decreases. Okay, that's the relationship. And with this, we have concluded the second chapter also. Now, just give me a minute. I'll open the next chapter. Yes, so let's start the next chapter that we are going to study, which is VRM 11, bond yield and return calculations. Okay, so in this chapter, our agenda is from the investor's perspective. If let's say you're investing in a bond, you might be interested in knowing what is the return that you are earning, okay, through over the investment period. So let's say you purchased a 6 month coupon paying bond, and a bond which pays coupons every 6 months, and let's say you kept investment for 6 months, for 1 year, or maybe even longer. And then after that, let's say you didn't use your money to buy it. Let's say you finance the bond with some kind of borrowing or something like that. So how the return is actually calculated, that we'll see. And also we'll also see the PL components. So what are PL components? Let me tell you. So banks are actually interested, or you can say the investors, big institutional investors are actually interested in knowing that if I'm investing in a security, okay, so over the time the bond price will change, I'll receive coupons, everything will happen. Okay, now along with this, why the bond prices are changing in the first place, we need to understand. Coupons are not going to change. Coupons is something that is certain that I'll receive. Okay, whatever the coupon is, be it $5 every 6 months or $10, I'll receive, that's for sure. Okay, so coupon is certain, but the prices are changing, and that can actually affect your capital gains. So let's say you hold the bond for 1 year period, and you sell it. Now you have the profit. Okay, now you want to find out what are the factors that contributed to this profit and what were their impacts. Okay, that how the profit was impacted by factor 1, how the profit was impacted by factor 2 or factor 3. Okay, so they identified that if I talk about the market dynamics, then there are factors like I would say time that will change. Okay, of course, time is certain to change. If 1 year has passed, 1 year has passed, time has changed. After 1 year, the bond has 1 year less left to maturity. So what is the profit that I earned just because of the passage of time? They would want to know. Second is uh, there are bonds which are not completely risk free. So there are certain kind of spreads or something like that. So they would want to know that what is the profit that I earned because of the change in the spread of the bond. Okay, change in the spread of the bond. That is something that we want to know. And also over time, the interest rates overall will change. Here in the chapter, while discussing the topics, we'll see the application using forward rates, but the same can be applied even with spot rates also. Okay, because we know that spot rates or forward rates are related. Okay, they will change accordingly. So I need to find out what is the profit that I earned due to the change in the interest rates. Okay, so there are three components to the profit. First component is profit due to the passage of time, which is called the carry roll down. Second component is profit due to the rate changes. That means over the 6 month or 1 year period, if the rate has changed by certain amount, what profit, what is the amount this has contributed in my profit. And third is the profit component because of the spread changes. Like over this, let's say 6 month or 1 year period, if the spread has changed, so what was the contribution of spread changes towards my profit? So we are basically breaking down the profit into the components, into the profit due to each of the factors which affect the bond price. Okay, so these are the things that we will be discussing in this chapter. So let's start our discussion. First, we will see realized return. So a bond's realized return is actually, of course, if you are calculating as an investor, your realized return, it's basically you compare your initial investment's value with the final value that you end up receiving. Okay. So a very basic example that I can take here is, let's say you made an investment for 6 months. Okay. And what happens here is, let's say you paid a price of $98. So that's a cash outflow, which is denoted by a negative number. Okay, negative sign. And at the maturity, you receive a coupon of 1.75. And at that point of time, the cash price of the bond was 98.5. Now, I'm not talking about the face value. And don't even assume that this bond is maturing in 6 months. It's just that I kept a bond for 6 months in my portfolio. When I purchased the bond, I paid a price of 98. And when I sold the bond, I got 98.5. Okay. And I sold it the moment I received the coupons. And I received a coupon of 1.75. Now I want to find out what is my realized return for this 6 month holding period. Okay. I'm not talking about the maturity. Okay. Forget about the maturity right now. So return is pretty simple. You will see that, okay, what is the net cash flow that I have over the 6 month period? So first of all, you will see that, okay, I received 98.5 by selling the bond. Second, you will see that you received 1.75 as coupon payments over the 6-month period. And then you will subtract the price that you had paid for the bond, that was 98. Okay. And then you divide it with your initial investment, that was 98. So that gives you 2.296%. Okay. Now the catch here is that this 2.296% is the interest earned over the 6-month period only. Now, usually when the interest rates are quoted, we want it to be quoted in in per annum basis. Okay. So we can, one way to do it is that we simply multiply it with 2. And we can say that whatever the number is, let's say, for example, here when we multiply it with 2, I can say that my annual return is 4.592% per annum with semi-annual compounding. Alternatively, if I want to have my annual return with annual compounding, so in that case, I can just transform this percentage return into annual compounding return. We have studied the formulas how to do it in the FMP 16 chapters using that. Okay, so in this case, specifically, your annual return is 4.592%. Next, we'll see that, let's say we are not holding it for 6 months, but rather we are holding it for 1 year period. Okay, it's a coupon paying bond, 6 months, every 6 months coupons are being paid. And the coupon that I receive, so my holding period is 1 year from now. So at 6 months from now, I'll receive a coupon. So what I'm doing with this coupon, that is also really important. Now, ideally in finance, we know that any intermediate cash flow is reinvested. Okay, so this 6-month coupon is also reinvested. And for the holding period, my holding period is 1 year. After 6 months, I receive a coupon. Now the holding period left is 6 months. So I receive this, I receive this coupon and I invest it for 6-month time period at the then prevalent return that is promised to me. Okay, so let's see how things goes. So here first I have the timeline, 0 months, 6 months, and 1 year. Then I have the first cash outflow. That means I'm making an investment and I paid $98. Okay, then I receive $1.75 at 6 months from now, and which I invest at the rate of 1.1%. Okay, now this is not per annum. It is the interest for this 6-month period. For the sake of simplicity, okay, that I have received 1.1% more after 6 months on this amount. Okay, and then finally at 1 year, you receive $1.75, and let's say you are able to sell the bond at $98.7. So you receive $98.7 at the end of holding period by selling the bond. So there are 3 cash flows at the end of the holding period. First cash flow is the cash flow from selling the bond. Second is the final coupon when you sold the bond. And third is the reinvested coupon that you receive finally, which is simply 1.75 times the interest rate that you have earned plus the interest that you have earned, which is simply 1.75 times 1.011. Okay, the sum, everything. Now, what is my return, realized return in this case? Of course, I'll add all the cash flows and subtract the cash outflows, add all the cash inflows and subtract all the cash outflows. So there are 3 inflows, 1.75 times 1.011, whatever the product is, then 1.75 and 98.7. These 3 things will be added. And then I'll subtract the cash price that I paid initially, 98. And then I will divide it by my initial investment, that is again 98. That will be my return for 1 year period. So when I do it, I get my answer as 4.305%. Okay, now this is my yearly return. If you look at this return carefully, in order to decide what is the compounding frequency of this return, okay, this return that is written here that I have calculated, it's actually 1 year. Okay, because everything that you have received is at 1 year from now. You cannot consider this as receipt because the moment you receive it, you invested it. Okay, you reinvested it. So reinvestment is happening instantaneously. Okay, so you are not receiving anything at 6 months from now. You're receiving and then again reinvesting. You receive it and give it. Okay, so inflow outflow happens both at the same time here at 6 months from now. Okay, so at 6 months there is 0 cash flow. Now you are calculating the interest for the 1 year horizon with no intermediate payments. Why no intermediate payments? One might argue that this is intermediate, but here what is happening? You are receiving 1.75 and you are giving 1.75. Giving means you are investing 1.75. Okay, so net cash inflow here is 0. So this interest that you have earned is 4.305% with annual compounding. Now, if you wish, you can convert it into semi-annual compounding. Just use the formulas that we have studied in the last chapters. Okay. And this is considered your gross return. Gross return, why? Because you didn't consider the funding cost. Now, usually what happens when when dealer banks buy or big banks buy or buy something, they fund it using something. And on the funds, on the funds that they have used, on the funds that they have raised in order to make the investment, they pay certain interest. So that has to be taken into consideration to find out the net return. Okay, so net realized return can be found like here it is given like with semi-annual compounding, it will be 4.26% per annum. Okay, now let's try to find out the net realized return. So for net realized return, what we have to do, we will have to subtract any financing costs if there are. Okay, any financing cost. So here we'll take both the scenarios one by one. First, let's see what will be the net realized return if in the first case that we discussed, and then the second case. Okay, so here my cash outflow initially was 98, which let's say I had borrowed from someone at certain rate of interest. It was financed for 6 months at 3% per annum. Here it is written. Okay, then cost will be 3% by 2 of 98. It is per annum with semi-annual compounding. That simply means, okay, so my cost of financing is $1.47. Now I know the cost of financing. Then at final 6 month, when at the end of my holding period, what I'm receiving is the coupon of 1.75, the price, the cash that I receive after selling the bond in the market, and I'll have to pay back the financing cost also. No? I have to pay back the financing cost. I borrowed 98, so now I have to pay back 99.47. So in extra, I am paying 1.47. So I'll subtract this also. So my net realized return in this case will be add all the cash inflows, that is 98.5 and 1.75, and subtract all the cash outflows, that is 98 and 1.47. And you divide it by the initial investment. So you end up earning 0.796% for 6 month period. If you want to find out 1 year return with semi-annual compounding, just double it up. You'll get the result. Okay. It will be something 1.59, something like that, 1.58, something like that. Okay. Per annum, it will be 1.59. Yeah, 1.592% with semi-annual compounding. Next, let us see for the second example that we took where the holding period was 1 year. So here what is happening? I borrowed $98 and I made the investment. At 6 months, I received 1.75 and then I reinvested it at the rate of 1.1%. That was the scenario. I had financed this $98 at 3% per annum. Okay. Now here I will be assuming that this 3% per annum is with annual compounding. Again, it's an assumption. In practical solutions, we have the ways that, okay, if it is with semi-annual compounding, then I can make the necessary adjustments, okay, in the formula. But here, just for the sake of simplicity, I'll be assuming that it's 3% per annum with annual compounding. Okay, so what is the cost? Okay, no. So here you see they have actually taken into consideration with semi-annual compounding. So the same formula has been applied and I find that the cost is $2.962. Now you might be wondering about this formula, that you might have not read this formula. So how do we arrive at it? It's actually really simple. You see, 1.105 square times 98 is your final payment that you will make. Okay, now what is your idea here? Your idea is to find the financing cost. So you will subtract the initial $98 that will give you the subtracting financing costs. Now, when you have that expression, if you just rearrange it properly, you will get this relationship. Okay, so that's the final result. It's basically the cost of financing is the final cost minus the initial borrowing. That's all that has been done here. Okay, final cost is 1.015 square times 98 and initial cost is 98. You can factor out 98, you will be left with this relationship. So my cost of financing is $2.962. Next, let's see the cash flows at 1 year at the end of the holding period. So I receive this amount, then I receive $1.75, the final coupon. Then I receive the sale proceeds by selling the bond, and then I subtract, then I pay the borrowing cost, that is $2.962. Okay, now what will be the return? Add all the cash inflows and subtract all the outflows divided by the initial investment. So inflows are 98.7, 1.75 times 1.011 and 1.75. These are my inflows. What are the outflows? 98 and 2.962. Divided by the initial investment of 98, you get the return of 1.283% per annum with annual compounding. Now, if you want, you can change it to semi-annual compounding or whatever compounding frequency you want it to be in. Okay. So that's how realized returns are actually calculated. Next, let us see spreads. What are spreads? Okay. So when you're buying a treasury security, you might be interested in finding out what is the excess return earned over the return provided by the treasury securities. So what it means is that sometimes it is possible that ideally a security should sell at, let's say, 102.5, for example. Okay, I'm just taking an example, but let's say you are able to buy it at $100 only. So this extra $2.5 saving, and let's say there are no arbitrage opportunities. Okay, it's selling, it's fair price. Okay, so this $2.5 extra that you were able to save was because of the excess riskiness of this specific security compared to some benchmark security. Okay, now in finance, people want that whatever profit or benefit I'm getting, I should convert it into interest rate. Okay, so I know that, okay, 6-month interest rate, for example, let's say is $5 or 5%, and 1 year is 5.5%, and so on. But by using this mathematics, you are seeing that the price should be 102.5. I got it at let's say 100. So what it basically means that I am earning extra interest. So this extra interest that you earn is called the spread. And the task at our hand is now to find the spread, excess spread that I have earned. And this spread is actually the compensation for the extra risk that I'm taking. That can be considered as a compensation at that point of time. Okay, so how it is done? So again, that's the explanation that is given here. Okay, the question that I need to ask. So let's consider the following forward rates. Again, I'm using the forward rates, but this can be done using spot rates also and yield also. I'll tell you a different method here, which is really easy. And in the exam, if you see a question, don't panic at all. Okay. Spreads can be calculated using yields also. Okay. So here the forward rates are given. That 0 to 6 month forward rate is 0.7%. Basically, it's a 6-month spot rate only. Then 6 to 12 month forward rate is 1.2 and so on. Okay, now I have the forward rates. Now I will find the discount factors. So the 6-month discount factor, I know the formula, discount factor and spot rate formula. I find the discount factor. 12-month discount factor in the same way. I use this relationship for forward rates and find the discount factor. Because these are the forward rates. Okay, these are not the spot rates. So we know that 1 year spot rate can be represented. The discount factor using 1 year spot rate can be represented by this relationship if we are using the forward rates over the given said period. That is 0 to 6 month forward rate and 6 month to 12 month forward rate. Similarly, 18 months discount factor can be calculated, and finally the 14 months will be this much. Okay, now I have recorded all the discount factors here. Okay, so these are the discount factors for half year, 1 year, 1.5 year, and 2 years. Next, my task is that, let's say, once I have the discount rates, now I'll see that, okay, the bond that I have purchased. So let's say there is an investor who was able to buy a 2-year bond, which is paying 2.5% coupon. And the price that he paid was 101.5. This is the price that he ended up paying. Okay. Now, if you use the discount factors that you have calculated earlier, okay, on the date of purchase, these were the discount factors, the one that we saw in the table. These were the discount factors on the date of purchase. Okay. And if I find the fair value of this purchase, it should be $102.226. Okay. But when I purchased it, I was actually able to get it at 101.5. So this extra earning that I have here, whatever it is, extra saving that I was able to make, that saving is actually the profit. Okay. So this extra earning, that is, I would say 102.226, 101.5. So this extra earning of $0.726, this extra profit benefit that I got, I then will convert it into spread. That means what is the excess interest that I'm earning every period? Okay, excess interest that I'm earning every period over the said interest rates, over the current interest rates. That is what I want to find it out. Okay, so for that, I'll assume that, let's say the spread is S. Okay, annual spread. A spread is also again calculated in annual terms. So annual spread is S. Gain is $0.726. Now, if S is a spread, then the gain can be converted into spread. Now I'm converting this gain of 0.726 into spread. Okay, spread, more interpretable. Is that I assume that the annual spread is S. So every 6 months, my spread benefit will be S by 2. Okay, and I simply add this S by 2 to all the forward rates. Okay, now here I have just written 3 terms, which means the 3 forward rates are considered, and 4 terms, which means all the 4 forward rates will be considered. Just to save a space, I have done this. I hope you guys will understand. Okay. And this, after making that adjustment for the spread, the price should equate to 101.5. Okay. Now, when we do the calculation, we will find that this S turns out to be 0.00366 basis points. Okay, 0.00366 in decimal terms. In percentage terms, it is 0.366%, and in basis points, it is 36.6 basis points. Okay. Now, in the examination also, when you will see, they might ask such questions. Okay, they might ask such questions. Now, as I said, that even if you use forward rates or spot rates or even the yield of the bond, you will get the same value of a spread. Okay, that is 36.6 basis points. Now, we all know that if we are doing the calculations using these forward rates, it is time consuming. And moreover, in the examination, what they can do is that they will give you the bond prices, they will give you the coupon rates, they will give you the time to maturity, everything. They will not mention anything about uh, the, I would say, what can I say? Anything about the forward rates. Okay. And they might ask you to find out what should be the spread on the bond. So you can, in that case, utilize the TVM buttons. Okay. So first, what you will have to do, they will give you the fair price as well as the price at which it was purchased. Fair price is 102.226. Okay. So what you will have to do in that case is that calculate the yield using first the fair price. It's easy. It's a 2-year bond, semi-annual coupons. So your N will be equal to 4. Okay. Then you don't know the yield. Forget about the yield. Okay. Then your PV. PV, it is known, it is 102.226. 102.226. Make it negative and insert it as PV. Okay. Then you have the coupon. It's a 2.5% coupon paying bond. So every 6 months, $1.25 is paid. So 1.25 you will enter as PMT. And then the face value, that will be 100 entered as face value. Then what you will do? CPT I by Y. Okay. You will get certain number. This is for the 6 month. Okay. Because while doing the calculations, when we use I by Y, it's for the compounding period. Okay. We find it. Then simply we'll multiply it with 2. Okay. We'll get certain number. In this case, it is coming out to be 1.350855. I'll simply store it. Okay. Or write it down someplace. Done. Next, what I'll do, I'll find the yield at the market price. That means the price that I ended up paying. So everything will stay the same. Only PV will change to 101.5. Okay. So 101.5 negative, it becomes my PV. Then I'll press CPT I by Y. I get again certain number. Okay. I'll multiply it by 2. And I get the number that I'm getting is 1.73. So 1.733677. Okay. Then I'll subtract the previously calculated yield from the new yield minus RCL1. I get 0.3828, which is very, very close to 0.366. Now, the difference that I'm getting in the result can be attributed to the fact that I have made certain calculation approximations here. Okay, that's the only reason for the difference from 36.6 basis point to 38.2 basis point that I'm getting. Okay, it's only 2 basis point difference. 2 also not, it's 1.6 basis point difference. Okay, that's because of the fact of the approximations that I might have done here. In the case of doing the calculation using the calculator, I was not doing any kind of approximation. Okay, so this is how you can use your TVM buttons to find the spread as well. Now let's move forward and let's talk about another thing, that is annuities. So annuities are basically, I have defined it in the one of the previous chapters only, that annuity is simply the dollar value that I need to invest today, okay, in order to receive $1 at each period. However, there is a different formula to calculate the annuity. If I have not $1 payment that I'll receive, but let's say I'll receive more dollars. Okay, let's say I'll receive some discrete dollars and I'm being promised certain yield, certain return, that okay, this is my, let's say I'll be earning 6%, 7%, whatever. Okay, so when this is the case, this formula can be used to find out the value of the annuity today. Okay, value of the annuity today. That means this much money, whatever I have, let's say my coupon is $5,000. Okay, and I'm expecting a yield of 8%, and I'm making the investment for 5 years. So I would want to find out that, okay, how much money should I invest today in order to ensure these cash flows in the future? Okay, so your C will be 5,000. Okay, every year. Your Y will be 8% every year. And then you can just use in the formula and you will find the answer. Okay, so that's how we do the calculation for annuities. Here it has been shown that it has a fixed time period. So every period I'm receiving certain payment, only the payments. No principal amount is paid in the case of annuities. Okay. Next, we have perpetuity. Perpetuity states that I'll keep on receiving the coupon payments, but there is no end date. That means I'll keep on receiving it indefinitely. Okay. Nowadays, perpetuities are not common, but during the world wars, some governments actually issued perpetuities, and some of them are still existing today. Okay. So how the value of perpetuity is calculated? Okay. So value of perpetuity is given as C by Y, where C is the coupon per year and Y is the yield per year. Okay. Even if you have similar compounding, then also this is the formula. Okay, why? Because this can be represented as, let's say, every 6 months I'm receiving C by 2. So C is the annual coupon. So every 6 months I'll receive C by 2. My yield will be Y by 2. These two gets cancelled actually. So you end up with a relationship which is C by Y. Okay, and here it extends indefinitely. Okay, there is no end to it. Either the issuer has to die, okay, with nobody else, or let's say the company ceases to exist, that company, which company had issued, or let's say if the country has issued, the country ceases to exist, then only this bond will not provide any cash flow, or until the time this bond paper exists, whoever is the holder will keep on receiving. Okay, of course, as per the terms, it has to be defined in the perpetuity contract. However, nowadays it is not common. Let me tell you, nowadays you have annuity. In fact, pensions and all that we receive are all forms of annuity. Okay, but perpetuities are not common. Now the coupon effect. So you see, coupon has an effect. Now coupon effect means that we compare the coupon with the yield. You see, in the last chapter, we did a comparison with coupon and par yield. There was a formula for calculating value using the par yield of the bond. Okay, that was 100 plus C minus P by 2 times 80. Okay, now using that, we were able to decide by just looking at the magnitude of coupon rate and par rate, that whether the bond will sell at a discount, at par, or at a premium. Okay, there is one more way in which we can do it, by comparing the coupon rate with the yield to maturity. Okay, so if you find that the yield to maturity is greater than the coupon rate, then things will be different. If you find that the yield and coupon rate are same, things will be different, price will be different. The nature of price will be different. And if you find that the coupon rate is greater than the yield, then the nature of the price will be different. Okay, how this happens, let's see. First, let's assume that we have a 3-year annual coupon paying bond, annual coupon, just for the sake of simplicity, and has a par value of $100. Okay, now if Y is equal to C, that means if the yield is equal to the coupon rate, bond will trade at par value. That means the price of the bond in the market, the value of the bond will be $100. Okay, it will keep on selling at par value. Of course, you will have to take into consideration the dirty price. We are talking about the clean price here. Okay, not the dirty price. Dirty price will fluctuate, but the clean price will stay constant at par value like this, the green line. Okay, if you find that Y is less than C, okay, that means coupon rate is greater than the yield, then you will see that the bond sells at a premium, or in other words, clean price will be greater than 100. However, as the time passes, okay, as the maturity comes near and near, the bond price gets pulled towards par. Okay, and exactly at maturity, the bond value will be equal to the par value. Okay, third is if the yield is greater than the coupon rate. Let's say yield is 8% and coupon is 6%. So yield is greater. So in this case, the bond will sell at a discount. That means the bond is clean price. Bonds clean price, not the dirty price. I'm saying once again, bonds clean price will be less than $100. But again, as the maturity nears, the bond price will be pulled towards the par. Okay, this is what we call pulling to par. Okay, as the maturity comes nearer and nearer, the bond price gets pulled towards par. Be it doesn't matter what the scenario is, whether the bond is trading at a premium or at a discount. As the time passes, the bond prices are pulled to par. Okay, so what can you say? What can you infer from here is that if, let's say, over the course of time, okay, let's say over a certain period, let's say 1 year, 1 or 2 years, if the yield stays less than the coupon rate, that means coupon rate stays higher. Okay, so you will see that there is a gradual decline in the price of the bond, clean price of the bond, gradual decline. Okay, so let's say today the price of the clean price of the bond was 104. So after 1 year, it is possible that the clean price of the bond will be 102. Okay, there will be a gradual decline if this condition is satisfied. Okay, if the third condition is satisfied, that is yield stays greater than the coupon rate, over the holding period, maybe it's 1 year or 2 years, whatever, then you will see that it was selling at a discount and it is getting pulled towards the par. That means the price will increase gradually. Okay, so you can say that when the bond is trading at a discount, okay, when the bond is trading at a discount and the condition that yield stays greater than the coupon rate over a certain period, then in that period, the clean price of the bond will actually increase. Okay, that means let's say today the clean price of the bond selling at a discount was, let's say, 97. So after 1 year, it is possible that it will have a price of let's say 98 or 99, something like that. Okay, and the same is true if you remember our example in the previous I think just a minute. Yeah, in this chapter only, we were talking about the return yield, realized return. Okay, so there, if you remember, the bond price that I paid was 98, correct? And after 6 months, it was 98.5, and after 1 year, it was 97 point something. Okay, that is in agreement with this relationship. Okay, and what this tells us is that the yield over the holding period stayed greater than the coupon rate. Okay, that's the important takeaway. Now, why I'm explaining these technical aspects, theoretical aspects, because these are the aspects from which they can frame theoretical questions. Okay, application scenario based questions, and you will have to answer that. Okay, there will be options, and if you're not aware of these things, it will be difficult for you to answer it in the actual examination. Okay, so I hope this is clear. Now let's move forward and let's talk about the interest rate risk. Again, I'll not go into the details as to why this happens. I'll just tell you that something like this happens because we don't have time. Like, it's a crash course, right? I time and again say that it's a crash course. We can't discuss everything in detail. I'll just give you the highlight which is important from the examination perspective. So here, if the coupon rate is lower, what can you say about the interest rate risk? Interest rate risk can be said to be higher. Okay, if the coupon rate is higher, interest rate risk will be lower. Okay, and if the coupon rate is 0, that means it's a 0 coupon bond, then for that we have the highest interest rate risk exposure. Okay, so this is the takeaway. So they might ask that, okay, this is the coupon rate environment, and so which of these bonds will have higher interest rate risk? They can make a comparative analysis. For example, they will give you two bonds. Okay, one bond 5% coupon, another bond 3% coupon, which has a higher interest rate risk. So naturally, the bond with the lower interest rate, that is 3% coupon bond, has a higher interest rate risk. These kind of questions can be framed. Okay, next, reinvestment risk. So coupon bonds have higher reinvestment risk than the 0 coupon bonds. Why higher reinvestment risks? Because in case of coupons, we saw when we were calculating the realized return that coupons are reinvested. So when you are reinvesting, what is the risk? The risk is that at that point of time, the interest rate being offered will be less. Okay, so I will be earning lesser interest rate on the reinvestment that I have made, on the coupon payment that I have invested back. Okay, but that is not an issue for the 0 coupon bond. Okay, why? Because in 0 coupon bonds, there are no intermediate payments. So I'm not worried about any kind of reinvestment. Okay, so that's why it is said that coupon bonds will have higher reinvestment risk corresponding to a 0 coupon bonds. Okay, corresponding to a 0 coupon bond. And that's a takeaway from here. And based on this, they can frame theoretical questions for which you guys should be ready. Okay, so let's move forward and let's see carry roll down. Now, when I started the discussion, I gave a brief overview of this chapter where I said that there are profit loss components. So whatever over the holding period, whatever profit I have earned, I want to know what are the factors that contributed to the profit. There are 3 factors that contribute. First is change of time. Second is change of spread. Third is change of rates itself. Okay, so carry roll down is the profit because of the change of time. And when we are calculating carry roll down, we assume that everything else will be same as it was 6 months ago. So let's say 6 months ago I bought a bond. I'll give you a brief premise so as you guys understand this PL components and carry roll down better. So let's say 6 months ago you made a purchase. Okay, you paid a price. At that point of time, there was some interest rate environment prevalent in the market. Okay, now for calculating carry roll down, there are certain assumptions that are made, and the most common assumption is that forward rates are realized. Okay, forward rates are realized. And what does it mean is that 6 months ago, let's say the forward rates were first forward rate. Of course, you know, when I say first forward rate, it's 0 to 6 month, second forward rate 6 to 12 month, and so on. Okay, so first forward rate was 1%, second forward rate was 1.2%, third forward rate was 1.4%. Okay, now 6 months passed. Okay, so 6 months passed, 6 months is gone. Okay, that period is gone. 1% wala period is gone. That period is gone. Now I am in, um, uh, now I have only 1 year left for my holding period. So in this period, 6 months ago, the prediction was that this rate, the current period is now has shifted forward, right? So this period would have a rate of 1.2%. And let's say today, the rate is actually 1.2%. This is what we call realization of interest rates. Okay, realization of interest rates. And with this assumption, I assume that nothing else has happened. Like after 6 months, maybe the estimates might have changed. Let's say in the market today, the 6 month spot rate is 6 month forward rate is first forward rate is, let's say, 1.1%, not 1.2. Second forward rate is, let's say, 1.5%, not 1.4. But I'm not considering them. I'm just considering what was the scenario 6 months ago, because I want to assess the impact of only the change in time. Okay, so I would assume everything else is constant. Nothing has changed. Okay, even the spread. And then we calculate the carry roll down. And the most common assumption for calculating carry roll, there are other assumptions also, but the most common one is that the forward rates are realized. Okay, what does it mean? I'll just show you here in the example. Okay, so let's take an example, and let's say for the time being that the term structure is flat at 4%. Okay, and an investor owns a 5-year bond paying a 5% coupon. Okay, you have a 5-year bond, it pays a 5% coupon. You find the present value, it turns out to be 104.49. Okay, these are the TVM buttons that you have to enter, and you get the present value as 104.49. Again, this is in agreement with the coupon effect. If you'll see, term structure is flat at 4%. That means my yield is also equal to 4%. And my coupon rate is 5. We studied if the coupon rate is greater than the yield, bond sells at a premium, and it is in agreement. It 104.5 is greater than 100. Okay. Now, after 6 months, so this was the scenario 6 months ago. After 6 months, what happens? 6 months has passed. Now, what is my N? My N is 9. Number of period is 9. Okay. And I will assume nothing else has changed. The term structure is still flat. PMT, of course, will not change. FV, of course, will not change. Then I calculate the PV. I get 104.08. Okay. Now, if I assume that my holding period was 6 months, so naturally what it means is that I realize $104.08. Correct? What is my net profit here? Okay, one is the interest income, which is in the form of $2.5. Second is the capital gain, which is the difference of the prices that I paid and then finally that I received. Okay, so here you see what has happened. My prices decreased basically. So I need to first find out what is the value by which my bond value decreased. It's 0.41. So this is the loss from the buying and selling of the bond. Then I have also received a coupon. So my carry roll down in this case is 0.4 coupon minus the 0.41. That is 2.09. So $2.09 is my return, is my earning just because of the passage of time. Okay, everything else is constant. The term structure is still flat at 4%. Yield is still 4%. Nothing has changed. If there is any spread, let's say hypothetically, then the spread also has not changed. Okay, here in this case, I have zero spread. So my carry roll down is $2.09. If something like this is the situation, then your PL component is only comprised of carry roll down. The spread component and the rate component will be, rate change component will be 0. Okay, if this is true. And again, if you just go back and remember the coupon effect, okay, then there at that point of time, I had mentioned that if during a holding period, the term structure does not change, okay, that means the yield stays the same and the time passes, the bond price will be pulled towards the par. So if it is above $100, the price will decrease. And it is true. You see, 1 year ago, the price was 104.49. Today, it is 104.08. Okay, this is all verified. And we are doing it on the coupon payment dates, all these calculations. So I can say in a way that this is clean price as well as the market price. Okay, because all the calculations are being done on the coupon payment dates. But if let's say the transactions are done on dates other than the coupon payment dates, then I do need to take into consideration the accrued interest, and also the calculation of clean price will be slightly different. Okay. Now this $2.5 that I received as interest income is called cash carry. Okay. And then I subtract any loss that I made while selling the bond, and it gives me the carry roll down. Yet another complex example is, let's say we consider a bond, which is a 2.5, same bond, 2.5% bond. Okay. But we have the forward rates. Okay. And in this case, again, I would say that this assumption forward rates are realized holds true. Why? Because it is written that the term structure is flat. If the term structure is flat, we know that all the rates will be same. Par rate, forward rate, spot rate, we have studied it in the last chapter. Okay. Even the yield. Okay. So you should remember that after 6 months, the assumption is true that the forward rates are realized. Okay. Now let's take a complete example where we have different forward rates for different maturities. Okay. And let's say the bond value is 102.226. We have done this calculation in the previous slides. Okay. The same bond I am carrying forward. Now to calculate the carry roll down, we will assume that the forward rates are realized. And let's say 6 months today, like when the bond was purchased. When I say today, that is when the bond were purchased. These were the forward rates. So 0 to 6 month was 0.7%, 6 to 12 months was 1.2, and so on. 6 months passes, forward rate realized means now what has happened? This is gone. So according to my analysis 6 months ago, this should be the new forward rate for the period 0 to 6 months when the 6 month period passes. Okay. So the same is true. You see 0 to 6 month is now 1.2, 6 to 12 is 1.6, and 12 to 18 is 2%. Okay. Now this is the scenario when we say forward rates are realized. If I had said that the forward rates are unchanged, okay, forward rates are unchanged, then it would have mean that if today the forward rate 0 to 6 month forward rate is 0.7%, then after 6 months also 0 to 6 month forward rate will be 0.7%. Okay. So when the forward rates are realized, last forward rate is discarded. When the forward rates are unchanged, yeah, I'm extremely sorry. When the forward rates are realized, first rate is discarded. Okay. And when the assumption is forward rates remain unchanged, last rate is discarded. Okay. That's a shortcut I can tell you. Now I have the rates 6 months ago and I have the rates today. That means I have the rates today, or other words, as if I go by the example, I have the rates today and I have the rates 6 months from now. Okay. And it is true because today I am expecting that 6 months from now, the 6 month rate will be 1.2%. And the same has happened. This is my forward rate realized assumption holding true. Okay. Now let's do the calculations and let's find the carry roll down. After 6 months, these are the cash flows because now only 1.5 years is left to maturity. Okay. Next, I can find the PV. Of course, I have done the calculation and all. PV turns out to be 101.334. Okay. You see in the last slide, when 2 years were left to maturity, the PV was 102.226. Now it is 101.334. Okay. So I'll find first change in the price of the bond. That is the difference between these two. And then I'll find the carry roll down, which is simply the coupon minus the change in the plus the any change. If the change is negative, it will be subtracted. If the change is positive, it will be added. My carry roll down is 0.358%. Now a catch here while calculating with the assumption that forward rates are realized, the benefit here is that you have a trick to calculate carry roll down. You are not required to do such lengthy calculations. Rather, what you have to do is just look at the interest rate for the current period. Okay, that is 0.7%. It is per annum, right? Per annum with similar compounding. Look at this interest rate, and that interest rate can help you find out what will be the carry roll down. What you have to all just to do is just multiply the interest rate for the period with the initial price of the bond. So 0.7% was the interest rate for the first period. Now first period has passed. Okay. So what is the interest earned on that period? This 0.7% was for 1 year. So for one period, that is 6 months, it will be 0.7% by 2. You multiply it with the price of the bond. You get the answer 0.358. Okay. That's the quicker way to do it. And in the examination, even if the questions are asked, they will ask to calculate carry roll down based on the assumption that forward rates are realized. And when they do so, don't go on doing the calculation using all this process that I have mentioned here. Instead, just use the quicker way. And let me tell you, quicker way works only when the forward rates are realized. There are other assumptions like term structure stays unchanged. That means forward rates will be same as what it is today. So if today 0 to 6 month rate is 0.7%, after 6 months also the 0 to 6 month rate will be 0.7%. Okay, that is forward rates remain unchanged. So in this assumption, this quicker way is not applicable. And since this quicker way is applicable in forward rates realized assumption, that's why this assumption is the most widely used assumption for calculating the carry roll down. Okay, remember these things. Now let's talk about the PL component. So as I said, we would want that what are the factors that are contributing towards my profit, and I want to just split the profit into those factors. Okay, into the contribution of those factors. First is the carry roll down, which we have already discussed, where I consider nothing, neither the interest rate, neither the spread. Then is the change in the price, the profit that I earned due to rate change and the profit that I earned due to spread change. So carry roll down is done. Now we'll talk about rate change and then finally spread change contribution. So now previous bond price was 101.5 and spread was 36.6 basis point. Okay, fair value was 102.226, the bond that we considered initially. Okay, when we were talking about the spreads, we are taking that bond only here. Okay, now after 6 months, when I calculate the PV, I find when I incorporate the fact that what can I say, that forward rates remain unchanged. Okay, here the assumption is forward rates remain unchanged. When the forward rates remain unchanged, I find the PV to be $100.79 after 6 months. Okay, along with the spread, where spread is not changing. Okay, now this should be the price of the bond when the interest rates are not changing. You need to understand, this is the price of the bond when the interest rates are not changing. Okay, now carry roll down we calculate as 0.54 for the bond. Okay, so this is my carry roll down. Interest rates are not changing, spreads are not changing. Only what has changed? Only the time has passed. Only the time to maturity has changed. Okay, so I get the carry roll down as $0.54 there. Okay, the second assumption that we are talking about. Okay, in the carry roll down, that's it. This calculation of carry roll down has been done using the second assumption, where I assume that the interest rates have not changed. You see, I'll just clear the confusion if there is any. Here, the calculation was done by assuming that forward rates are realized. Okay, you see, assuming forward rates are realized. And here, I am calculating the carry roll down by assuming that the forward rates are unchanged. So 6 months ago, if the forward rate was 0.7%, today also, after 6 months also, the six month rate is 0.7%. Okay, so the same logic applies here. And we find the carry roll down to be 0.54%. Okay, now here, the only thing that changed was the time to maturity from 2 years to 1.5 years. I got the carry roll down and this is the price. Now using shortcut, I can do it like this. Okay. Now my task is to assume that the forward rates after 6 months are different than what it is given. Okay. So it was given that the forward rates will be 0.7% and something like that, but it is different here. Let's say in reality, after 6 months, the forward rates are 1%, 1.4% and 1.8%. Okay. That's the idea here. Now, what will be the price of the bond using the new rates? The price of the bond will be 101.09. Okay, 101.09. This is the new price of the bond. If I find the price using the changed forward rates. Now, what is the PL component because of the fact that the rates have changed? You see, this was the price when the rate did not change at all. Correct? This was the price when the rates did not change. So now, and this is the price when the rate changed. So I'll simply take the difference of these two. That will give me the PL component because of the change in rates, only the rates. Again, till this point, you see in the last question also, spread was assumed to be constant. Here also, spread is assumed to be constant. Okay. So impact of forward rate change is $0.30. Okay. Or you can say profit due to rate change is $0.30. Then finally, we will relax the assumption that we'll use the spread change also. So it is possible that after 6 months, let's say initially the spread was 36.6. Now after 6 months, the spread decreases to 30 basis point. It's possible. These things can change. They are dynamic in nature. Okay. Now my spread is also different. So what I'll do, taking the spread of 30 basis point, if we calculate the new interest rates, of course, these interest rates have been taken into consideration. Okay. The new interest rates. Now I'm assuming that everything is changing. The interest rate has changed, time has passed, and then I am assessing the spread change also. Okay. So the price of the bond turns out to be 101.19 with 30 basis point spread. Okay. Now, what was the price when the spread did not change? It was 101.09. Now the price is 101.09. So if I take the difference point between these two numbers, I'll get the profit component because of spread changes. That is $0.1. Okay. Now let's see. This is the actual final price of the bond at 6 months from now, 101.19. Okay. Now let's see. Net decline in the price is, when I purchased it initially 6 months ago, I purchased it at 101.5. Today its price is 101.19. So the net decline is 0.31. I have received coupons also. Okay. Coupon was worth 1.25. So my net gain on this position is 1.25 minus 0.31, that is 0.94. Now this is my net gain. Now what I have done is that I have factored this net gain into component gains. Okay. So out of 0.94, how much I have earned just because of the change in time to maturity. So that is $0.54. Again, out of this $0.94 that I have earned, how much I have earned because of the changes in the rates only. Okay, rates only. That is $0.30. And then finally, out of $0.94, how much I have earned because of the spread changes? It is $0.10. Now you just add them. These are the calculations that we did in the last slides, right? 0.54 was the carry roll down, 0.3 was the spread change, and 0.1 was our 0.3 was rate change and 0.1 was our spread change. Now you just add them all, you will get 0.94, which is our actual gain by just considering the difference in the price and adding the gain, adding the interest payment to it. Okay. So this is the bifurcation of $0.94. Okay. Alternative way to say it is that when you sell the bond, you will immediately get to see this gain, $0.94. Now you want to find out what is my carry roll down, what is the contribution of carry roll down, what is the contribution of rate changes, and what is the contribution of spread changes. Then you can utilize all the steps that we have done in the previous slides to find the result. Okay. So with this, I would say that we have concluded the lecture. Okay. So now now I'll open the next slide, next chapter. So just give me a minute. Yes, so now let's start with the 12th chapter, that is VRM 12, applying duration, convexity, and DV01. Okay, so in the last 3 chapters, the thing that we have studied were mostly related to bond valuation, calculating the returns, the component of the profits, things like that. Okay, from this chapter onwards, in fact, in this chapter and the next chapter, we are going to talk about the interest rate risk. So when you're investing in a bond, the thing is that we are exposed to the changes, the risk due to changes in the interest rates. So if, for example, if the spot rates change, we know that the price of bond will fluctuate. We have studied coupon effect, everything we have seen that the price of bond will change. So now if let's say you are a big pension fund, or let's say you are a big financial institution who is holding a bond portfolio, large bond portfolio. So usually the case is with pension funds, big mutual funds, hedge funds, or I would say insurance companies, they invest in long-term securities for a longer period of time. So the idea is that they are not going to change the portfolio composition for a certain period of time. At least in the medium term, they are not planning to change it. Now, everybody is aware that, okay, if I'm not changing, the interest rate environment is unstoppable. It will keep on changing. It depends on the market dynamics, a lot of other factors, investor sentiment, supply, demand, everything. Okay, so interest rates will fluctuate. Now, in order to save, now there is a dilemma here. So the dilemma is that they don't want to change their portfolio quite often because it will lead to huge transaction costs. The portfolio value will keep on changing, thereby reducing the profits, okay, that they might earn substantially. Now, if it is done once or twice, it's not a big deal. Okay, the costs can be managed. But if it's done very frequently, quite frequently, then the costs will surmount to such an amount that the profits, these institutions won't be left with so much of a profit to give out to the dependents who are actually the dependents on that. Okay. So what the idea is that is it any they asked a question that is there any way possible that I don't change the portfolio dynamics, but still I'm able to reduce the losses that I might incur in the portfolio due to the changes in the risk factors. Okay, and the answer, the most important and prominent risk factor is the change in interest rates. So the answer was, what if I'm able to hedge for the interest rates? Okay. Yeah, I have not changed the slide right now, so it's not changing. I'm just giving you the overview. You see, by now you might have got an idea that whenever I explain the chapter, whenever I start a chapter, I give a brief premise, right, of the chapter, that what we are going to do. What is the logic behind studying a chapter? Okay, so as to make it more relatable, so that's what I'm doing right now. So the idea is that I want to reduce the interest rate risk. If I am able to reduce it, then I won't have to change the portfolio. And also, where you have seen that we have derivatives and all, and reducing risk exposures with the help of derivatives is less costly compared to changing the composition of portfolios altogether. Okay. Now, what are the risk factors that are actually dependent? What are the risk factors? Of course, the most important one is interest rate. Now we want to find out the measures, or you can say the parameters, the in simple terms, the words that actually refer to the different parts of the component, the different aspects of the interest rate risk. And this is duration, convexity, and dv01. Okay, now what these duration, convexity, and dv01 infer? They simply infer the risk, the exposure, or you can say the loss that a portfolio might incur because of the change in the underlying interest rate. They give us a precise approximation of those risks. And if we are able to manage these measures like duration, convexity, and dv01, we can manage or reduce the losses on the portfolio to a large extent. Okay. However, we'll take into consideration their limitations also, and what improvements we further made in order to enhance the management of interest rate risk, which is the part of next chapter. Because you see, in this chapter, the idea is that there is a parallel shift in term structure. So all the rates are dependent on one factor. And if one rate increases by 10 basis point, then all the rates are increasing by 10 basis point. That's the idea of parallel shift in term structure, which do happen in practice, of course. But quite often you will see non-parallel shifts in term structure. And duration, convexity, DVO1, whatever these are, all these three measures fail to capture the dynamics of non-parallel shifts. In other words, if you are expecting a non-parallel shift and you go for duration, convexity, or let's say DV01 based hedging, the hedge will not be optimal. So what is the way out there? The way out there is the key rate exposure. Okay, hedging for the key rate exposure. That is the agenda for our next chapter that we'll discuss. But first, let's start with this chapter, that is VRM 12, applying duration, convexity, and DV01. Okay, so let's see what we have here. Some important metrics that analyze the fixed income portfolios basically are the DVO1, which is actually dollar value 01. In other words, it measures what will be the change in the value of the portfolio, dollar value. What will the change? What will the dollar value change? Okay, or change in the dollar terms. Okay, in the value of the portfolio if the underlying interest rates change by 1 basis points. That is DV01. Okay, dollar value 01. Next, you have the duration, which tells us if what will be the change in the interest rates. Okay, linear change, precisely. What will be the linear change in the interest rates? In the price of the portfolio, not interest rate, in the price of the portfolio, if the underlying interest rates change by 1%. Okay, and then finally, we have convexity, which is actually an adjustment for duration, because in practice, we know that price curve of duration is not linear. Okay, so duration is an imprecise measure. It is helpful if and only if we have small changes in the interest rate term structure. If the term structure change is large, let's say if the change is beyond 10 basis point, then duration based hedging becomes imprecise. So we need a better measure to address the curvature, to address the curve that we see in the bond prices, which is captured through convexity. So duration plus convexity is a better way to hedge against the interest rate risk arising due to parallel shifts in term structure. And DV01 also is a way to hedge for small changes in the interest rates due to a parallel shift in term structure. So all these three measures are for the parallel shifts in term structure. Okay. Now, these three measures assume that all the interest rates depend on one factor. Okay, that factor can be any other interest rate, let's say 5-year interest rate. So for example, if 5-year interest rate changes by 1 basis point, all other rates will change. So 5-year interest rate actually becomes your prime factor. Okay, and we want to hedge against that. Now the one factor assumption, actually, as I have already mentioned, it mentions that all the interest rates move by the same amount, and the simple model says that the shape of term structure never changes. If the shape is upward sloping, it will stay upward sloping. That means there will be no flattening or steepening. Okay, be it upward sloping term structure or downward sloping term structure or flat term structure. If there is a parallel shift in term structure, the shape will stay the same. There will be no flattening or steepening. Okay, here it is shown that initially my term structure looked like this, the blue line, but if all the rates increase by same amount, it gets transformed into the light blue line, which is parallel to the initial term structure line. This is this is parallel shift in term structure. And all these measures, be it DVO1, duration, convexity, they are best in capturing the parallel shifts in term structure. However, one factor term structure shifts does not need to be parallel, do not need to be parallel. In fact, you can have non-parallel shifts. And as I said, this one factor term structure is that all the rates, the change in all the rates depend on one factor. So in case of parallel shift, the idea is that if that risk factor changes by 1 unit, all the other interest rates, all the interest rates will change by, let's say, 10 basis points. That indicates parallel shift. It is also possible that there is one factor only, and let's say this factor actually affects rates differently. So for example, it is possible that the risk factor might affect the short-term rates, medium-term rates, and long-term rates in a different way. Okay, that can actually lead to non-parallel shifts in term structure. So it is possible, if I take a very simple example and I just ignore the medium-term rates, so there will be short-term and long-term rates. So if I say that if risk factor changes by 1 unit, then short-term rates will increase by, let's say, either increase or decrease by 10 basis point, and the long-term rates will either increase or decrease by 5 basis point. So here what you see, here changes are happening in the rates, but short-term rates are changing by more than the long-term rates. Okay, so here you will have a non-parallel shift. And again, if you see it graphically, this is our initial term structure line. And if we see a non-parallel shift, that means long-term, short-term rates increase by more amount compared to the long-term rates. And we see that there is a flattening happening. Okay, we see that this term structure rate flattens. It can also lead to steepening of the term structure. Just we have to do is, in this specific example, the long-term rates will have to increase by more amount than the short-term rates. So if the long-term rates increase by 10 and the short-term by 5, you will see the steepening of term structure. And this is an example of non-parallel shift. So when I say parallel shift, it simply means that the line, the interest rate line that you're seeing here, okay, on the XY coordinate where X is maturity and Y is the rate, it simply shifts parallelly above it. Okay. And in non-parallel, like some rates are changing by large amount, some rates by lesser amount. Okay, that's non-parallel shift. Now let's talk about DVO1. So the formula for DVO1 is given as negative of delta P by delta R, where the change in R, delta R is the change in the interest rate, where the change in the interest rate is measured in basis points. Okay, now this is a very important thing to consider, because when I say basis point change, what does it mean? Is that my delta R, if I say that my interest rate changes by 0.05%, it means my delta R is 5 basis point. Okay, we know that 100 basis point is equal to 1%, correct? And 100 basis point is 1%, or in decimal terms, I would say 1 is equal to 10,000 basis point in decimal terms, because 1% in decimal terms is 0.01. So 1 basis point in decimal term will be 0.3 times 0 and 1. That is 0.0001. Okay, so now let's start our discussion. First, we'll see how DV01 is calculated, and it's pretty simple to calculate actually. So the formula for DVO1, another formula is delta P minus of delta P divided by delta R times 10,000, when delta R is measured in, I would say, decimal. Okay, when delta R is measured in decimals. Okay, not in percentage, in decimal. Here, delta R is measured in basis point. So if I say 5 basis point, I'll simply write delta P by delta R, that is 5, delta P by 5. Okay, if it is given that the interest rate change by 0.0005, okay, so in that case, it will be delta R times 10,000. Okay, that will actually get converted into 5 only. Okay, because if you multiply 0.0005, it turns out to be 5. Okay, now for a bond, DVO1 is actually positive, and it's because of the fact of the formula, in which the way in which the formula is designed. Again, I'm not going to go into the derivation of the formula. If I go to the derivation, you can understand why this negative sign comes in. Okay, it's all because of the derivation. But if you just look at it, because the DVO1 formula looks like this, after derivation, it is negative of delta P by delta R, where R is in basis point. Let me explain the first formula. So for a bond, we know that if delta R is positive, okay, delta P will be negative. That means if interest rate increases, bond price decreases. If delta R is positive, delta P will be negative. Okay, so this expression delta P by delta R, just ignore the negative sign. This expression will be negative, and negative times negative becomes positive. So delta P becomes positive when delta R is increasing. Now, if delta R is negative, delta P will be positive. So the thing is delta R is negative. Now here you have a negative sign. Okay, so this whole fraction becomes negative, and finally when you multiply it with a negative sign, it becomes positive. So no matter in which direction the price is changing, for a long position in a bond, DVO1 turns out to be positive. There are certain, I would say, financial assets or derivatives which have a positive correlation with the interest rate. So that means if the interest rate increase, the value of the security will increase, of the asset will increase. So there, in those cases, you will see that the DVO1 of such securities will be negative. DVO1 of long position in such assets will be negative. Okay. But here we are studying everything from the perspective of bond. So for bond, it will turn out to be positive at all times. Now let's see an example. So here we have the spot rates for different maturities, and the maturity is 3 year. I have a 3-year treasury bond, and it has a face value of $1 million, and coupon is 10% per annum, which is paid semi-annually. Okay, so clearly the present value will be greater than $1 million, of course. So here the cash flow has been shown. These are 50,000, 50,000, and here you have 1,050,000. Okay, as the final cash flow. Now, old PV, or you can say when these are the rates, okay, with these rates, okay, these rates, the present value of the bond is $1,037,922.032. It can be calculated. You can apply the formula. These are the rates. Find the present value of all the coupons and they add them together. You will find this value. Okay. Now, what I will do, in order to calculate the DVO1, I will assume that all the rates increase by 5 basis point. Okay. So when this happens, that means delta R is plus 5 basis point, or in percentage terms, delta R is 0.05%. In decimal terms, delta R is 0.0005. Okay, so that's the idea. So I have delta R of plus 5 basis point. So my new rates will be, first rate, half year rate will be 7 plus 0.5%, that is 7.05%. Similarly, all other rates becomes 7.5 to 7.55, 8.0 to 8.05, 8.3 to 8.35, and so on. Okay, now using these rates, I will then estimate the value of the bond once again. Okay, using the new rates, increased rates. I find that the value of the bond turns out to be $1,136,594.522. Okay, then I'll calculate delta P. Delta P will be new price minus the old price, which is minus of 1327, which indicates that my price has in fact decreased by $1,327.51. Okay. Next, what I'll do, I'll find the DVO1. I'll apply the formula, the minus of delta P by delta R. So minus of minus 1,327.51 by 5. It turns out 265.502. Okay. So how do we interpret it? And this is the DV01 when the interest rates increase. Okay. DVO1 when the interest rates increase. I would interpret it as, this is the change in the price of the bond if the interest rates increase by 5 basis point. Okay. If the interest rate increase by 5 basis point, this is the change in the price of the bond, and precisely decrease in the price of the bond. Okay. Next, our assumption will be to find the DVO1 when the price decreases. Okay. When the price decreases. And why we are doing it? Because we know that there is a nonlinear relationship. Okay. And if there is an increase in the price, the increase is large. And if there is a decrease in the price, the decrease is less, slightly less. When we'll see it, it is evident here. Okay. So now we'll assume that delta 5 is minus 5 basis point. Okay. That is minus 0.05%, or in decimal terms, minus 0.0005. Okay, so the new rates will look something like this. The first rate will become 7% minus 0.5%, which is 6.95, and so on. Okay, now I calculate the price. I get the price to be $1,039,251.681. Okay, then I calculate the delta P, that is the new price minus old price. I get it as 1,329. Now you see what I was mentioning. When the price increases, it will increase by more than the decrease in the price. So increase is 1,329, but when there is a decrease of the same amount, the price decreases by 1,327 only. So there is a slight discrepancy in the actual increase and decrease of the prices. Okay, now then again, I'll calculate the DVO1 when the interest rate decline, and it turns out to be 265.9298. Okay, you see previously it was 265.502 when the price is increasing, when the interest rate is increasing. When the interest rate is decreasing, the price is 265.9298. Okay, so what value should be taken as the DVO1 of the bond? Okay, so let me just tell you, there the thing has been written, new price, increase in the price, and the DVO1 estimate. They are slightly different. Okay, so what should be the DVO1 of the bond here? Should I take this one or should I take the lower one? Okay, should I take the below one? So the best approach here, as per the theorists and economists who have prepared the theory, okay, is that take the average of these two. Okay, take the average of these two. So I'll take the average. When I take the average, I get 265.72, and I'll say that 265.72 is the DVO1 of the bond. End of the story. Okay, that's how DVO1 is calculated. Now let's see how we hedge using DVO1. So if let's say I know the DVO1 of my bond portfolio. Okay, let's say for the time being that it's a single bond portfolio. Okay, so now if I have to hedge, I only need to hedge for the DVO1. If I reduce the DVO1 to 0, so no matter what happens to the interest rates, if these are small changes, no matter what happens to the interest rates, my bond portfolio value will not change. It will stay the same. Okay, so I know that DVO1 is given by this formula. Okay, now what does it mean is that if I have a DVO1, let's say for some asset which is negative of 150, okay, minus 150, what does it increase? What does it indicates? It indicates that either of these two. So if portfolio value increases as the delta R increases. So if there is an increase in interest rates, the value of the portfolio will increase. If there is a decrease in interest rate, the value of portfolio will decrease. Negative DVO1 indicates this thing. Okay, positive DVO1, if it increases, if R increases, value will fall. If R decreases, value will increase. Positive DVO1. Okay. Now, change in the value of the portfolio, delta P can be given as D times delta R. Okay, delta P is D times delta R. That is DVO1 times delta R. 150 times delta R. Okay, so now let's see an example and understand how hedging is done. So I have a position which has a DVO1 of minus 150. Okay, it has a par value of $1 million. This is my existing position. My existing exposure is minus 150 in the DVO1. Okay, my existing DVO1 exposure is minus 150. And let's say I have a hedging instrument, which is the previous bond that I considered. And using that bond, I want to hedge my existing DVO1 exposure. And the hedging instrument DVO1 is $265.72. So how will I hedge? The principle is really simple. Okay. 265.72. Here I have actually, this has been shown using the unitary method, and it's really simple to understand here. Okay. 265.72 is the DVO1. Or in other words, you can say when the portfolio value is $1 million, or you can say when the face value is $1 million, DVO1 is 265.72. So when the DVO1 is 1, when the DV01 is 1, the portfolio value should be equal to this amount. Okay. And my existing DVO1 is minus 150. So I'll write when the existing DVO1 is minus 150, the face value amount should be equal to 564,503.99, or roughly $564.504 of the face value of the hedging instrument. So if I invest in this much amount of face value of the bond hedging instrument, I will be able to reduce my exposure. Okay, I'll be able to reduce my exposure. Now the formula here will be minus of V times DVO1 of P divided by the DVO1 of V. Okay, this is the formula. And whatever answer you get, if you at the end you see a negative sign, that means you have to go short in the hedging instrument. If you see a positive sign, you have to go long in the hedging instrument. Here, I would say there is a mistake because actual position has a minus 150 DVO1. Here it is taken as plus 150. If it is plus 150, this number indicates that I need to go long in this much face value amount of the hedging instrument. If it was negative, then it would mean that I need to go short in this much hedging instrument of this much face value of hedging instrument. Okay, minus V by DVO1 of P by DVO1 of V. DVO1 of P means my position. DV01 of V means the hedging instrument, DVO1, and minus V is the hedging instrument value. Okay, what is the value of hedging instrument? This is the relationship that you can take away from this slide. And this is the most important relationship that is utilized to find hedging position using DVO1. Okay, again, important from the examination perspective, I would say. Next, effective duration. Effective duration actually can be calculated using DVO1. And it's just that for finding out effective duration, you just need to divide the DVO1 with the price of the bond. Okay, but here is a catch. Okay, we need to look back and retrospect about what the definitions of duration and DVO1 are. Okay, so DVO1 tells us that, or DV01 tells us that it is the change in the price of the bond if the underlying rates change by 1 basis points. Okay, the idea is basis points. So the way in which the interest rates are measured in the case of DVO1 is in the terms of basis points. Okay, but now look at the definition of duration. Duration is the proportionate, the percentage change in the price of the bond. That's why we are dividing the price in order to get the percentage change. Till this point, it's okay. Okay, this formula looks okay, that DVO1 by P. Percentage change in the price of the bond if there is a 1% change in the price of the bond. Okay, 1% change difference. There it is basis point, here it is 1%. Okay, so that's the difference. Now, D times P is equals to DVO1. I can write it quite easily. So here I have DVO1 and I have the position. Okay, I can calculate the D as DVO1 by P. Okay, DV01 divided by P, but the number turns out to be 0.000265. This is not your duration. Why it is not our duration? Because here, by definition of duration, the interest rates need to be measured in decimal term. That is 0.01 if it is 1% change. Okay, so I need to take that fact into consideration. In case of DVO1, the interest rate change was being calculated in basis point. Okay, so let's see different variations. If here delta R is in basis point, when delta R is in basis point, duration is 0.000625. And the interpretation of this number will be, if the interest rate change by 1 basis point, the percentage change, the change in the value of the portfolio will be 0.000265. Okay, that's the interpretation. The proportionate change, not percentage, proportionate change. Next, if I assume that the delta R is in percentage terms, that means percentage means you will multiply it by 100 once more. Okay, so you get 0.0256%. Okay, again, that's not true because here for duration, delta R has to be measured in decimals. Okay, so you multiply it with one more 100 and you get D as 2.56. And this becomes your answer. Okay, so always remember when you are calculating duration from DVO1, the final formula should look like DVO1 times 10,000 divided by the price of the bond. Okay, that will be the final formula to calculate the duration. And that will always give you result like this, like 2.56 or whatever. So 2.56%, and I would interpret it as if the interest rate changed by 0.01 or 1%, then the value of the bond will change by 2.56%. Okay. Now let's understand the difference between effective duration and DVO1. So you see, DVO1 and effective duration is just because how, like, let's say you want to hedge. So whether you should hedge through DVO1 or duration. Okay, whether you hedge for the duration or you should hedge for the DVO1. We should not hedge for both of them, correct? Because both of them are related to an extent. First is DVO1 is appropriate to consider the impact of rate changes on the value of the position in dollars. So if you are more interested in the change in position in dollar terms rather than in percentage terms, then you would use DVO1. as a measure of risk. Okay, it will give you the dollar value change in the value of the portfolio, dollar change in the value of the portfolio, DVO1. Effective duration is appropriate when we are more interested in the percentage change of the position value. Okay, in other words, I want to know by what percent the value of the portfolio will change. Then duration is considered effective. So they have their own application depending on what is the appropriate culture within the organization. You can choose between DVO1 and duration. DVO1, again, another difference is that DVO1 increases as the size of the position increase, because DVO1 is dollar terms. If you have more dollar position, the DVO1 will be large. So for example, if for $1 million, DVO1 is 265, for $2 million, roughly I would say it is the double of 265. Okay, that's 530. Okay, but in case of duration, it's irrelevant, is invariant towards, I would say, the position size. No matter what happens to the position, it's the percentage change. Okay, so the percentage will stay the same. 2.56% is your duration, irrespective of the size of the portfolio or position. Okay, now let's talk about convexity. So convexity, the formula to calculate effective convexity precisely is P plus P minus 2P divided by delta R squared. Whole thing is divided by price of the bond, current price of the bond. And here the catch is delta R is measured in decimals. So if it is 5 basis point, it will be 0.005. Sorry, 0.0005. Okay, will be squared. P plus is the price of the bond when the interest rates increase by delta R. P minus is the price of the bond when the interest rates decrease by delta R, and P is the price when there is no change in the interest. Okay, that means the current price. Okay, and this numerator, if you will see, it's basically a relationship which can be simplified as P plus minus P and P minus minus P. That means change in the price of the bond when the interest rate increase, change in the price of the bond when the interest rate decrease, and then dividing it by the delta R square value. Okay, that gives us the value of convexity. Okay, now let's see the effective convexity example. So we know that convexity alone has no meaning. Convexity plus duration has some meaning, and hedging for duration is similar to the hedging for DVO1. Okay, you can have the similar formula. Okay, where DVO1 will be replaced by duration of position divided by duration of the hedging instrument times the value of the hedging instrument. Okay, that will give you the hedging position. Now, if let's say the price of the bond is given to me, okay, delta R is plus 0.005, that means 5 basis point increase. Then I have P plus and then I have P minus, first for increase in the bond price, then for decrease in the bond price. Sorry, increase in the interest rates and decrease in the interest rates. When interest rates increase, bond price becomes 1,036,000. When interest rates decrease, bond price becomes 1,039,000. Okay. And next we have to use the formula to find the convexity. So now I'll calculate the convexity. I'll just put in the values. Okay. And we will find it to be 8.2434. Okay. This is my convexity. Now let's see convexity along with the impact of parallel shifts. When we are assuming that the interest rates are having parallel shift, all the rates are increasing by the same amount. Okay. So if delta is 5 basis point, all the rates are increasing by 5 basis points. In fact, in the case of DVO1 calculation also, you can see that when we were calculating DVO1, we were assuming that all the rates are increasing by 5 basis points. And that's why it is said that all these three measures, be it duration, convexity, or DVO1, works well when we have a parallel shift in term structure. For non-parallel shifts, we'll study how to deal with it in the next chapter. So these are the cash flows that we have. Now, let's say the interest rate increase by 20 basis point, okay, or 0.2%. So new interest rates will be simply 0.2% plus all these numbers. Okay. And when we use the new interest rates, we find that the new present value of the bond will be 1,032,624.792. Okay. It's the same bond that we used in the previous example. Okay. So that you will understand, you will be able to appreciate the importance of convexity. Okay. Now let's see what the actual delta P is. Now, in order to find the new PV, what I have done, I have re-estimated the price of the bond using the new rates. Okay. Now, re-estimation is challenging. Why? I will tell you. You see, usually when you have a bond portfolio, first of all, these bonds are very long-term bonds like 20 years, 30 years, 15 years, things like that. Coupons are paid semi-annually. And then at the same time, it does not contain only one bond. There are different types of bond with different types of risks. That means they will have their own spreads. Okay. So if you are re-estimating the bond price again and again, it's very time consuming. You want to save time. However, just to make a comparison, we actually re-estimated the bond price and we found what will be delta P. And I find that delta P will be minus $5,297.24. That means my bond price will decrease by this amount. Okay, this is actual. Now, duration is a way to estimate the change. Okay, it does not tell us what will be the exact change. It tells us what will be the approximate change. Okay, using a shortcut. So this is the actual change. Now, if I find the change in the price of the bond using duration, delta P is given as minus dP delta R. Okay, I apply it and I find that if I try to approximate the change in the bond price using the duration, then it will tell me that the bond price should fall by $5,314. But in reality, it is falling by $297. Okay, so roughly there is a difference of, I would say, $17. Okay, the change that is being estimated by dollar is not exactly the actual change, is not exactly equal to the actual change. Okay, that means duration alone is not sufficient enough to tell me a precise estimate of change in the price of the bond. Okay, it cannot tell me the precise value of delta P, or its precision is much lower. That means its reliability is questionable. Okay, especially when the change in interest rates are large. Here, interest rate change is 20 basis point, which is large. Okay, now let's see. This is the prediction using bonds. Okay, so you're predicting 5,314. So you will be planning according to it, but in reality, something different happens. And here that too, the portfolio is really small. $1 million is nothing. When you look at the portfolios of big institutions like hedge funds, not hedge funds, but yes, mutual funds and insurance companies, they have huge portfolios. They have investments in billions of dollars. So there it can have an impact of millions of dollars. Okay, this slight difference error that you're seeing can have an impact of, if not millions, then at least hundreds of thousands of dollars. Okay, and that's reduction of profits. Okay, they want to, and $100,000 is not a small sum of money, right? So although here it seems small, that okay, it's only $17, why someone should be worried about it? Just increase it by 1,000 times. Let's say it was $1 billion, then it would have transformed into this discrepancy would have transformed into $17,000. That's kind of a salary to a person. Okay, a good salary, I would say, not a bad one, a good salary to a person. So we take into consideration the convexity. And when we combine duration with convexity, the delta P, the change in the price of the bond, is predicted using this relationship. It is minus dP delta R plus 1/2 Cp delta R square. Okay. Now let's see what will be the change in the price predicted if I use duration as well as convexity together. Okay, we had calculated what was the duration. The dP delta R has been already calculated. It was minus 5314.16. I just need to find the second part. Okay, in the previous slide, I have calculated it. Okay, so we just need to find out the second part. When I do this, I find that it is 5297.04. Okay, now actual change was how much? 5297.14. So the difference is only $0.1. Okay, now just increase this manifold. Okay, increase it by manifold, let's say by 1,000 times. Let's say the portfolio was $1 billion. So the difference would be 0.1 times 1,000, that is $100. So from 17,000 of discrepancy to just 100, that when we were considering the duration, the error was 17,000. But when we use duration along with convexity, the error reduces just to $100. Okay, so that's the benefit of convexity. It adjusts the change in the bond price. Okay, it takes into consideration the non-linear nature of the bond prices. Okay, now the actual percentage change here, these are the takeaways. Percentage change in the bond price is always greater than that predicted by the duration. Duration overestimates the magnitude of price decrease. When there is a decline in the price, it will overestimate the change. It will say that, in fact, it was happening. Actual change was 5,297.14. But as per duration, it was 5,317 or 314. That's overestimation. It was saying that there will be a more decline. On the other hand, if there is a price increase, duration will underestimate. So instead of, if let's say actual change will be, let's say 5,400, then duration will tell us that the change will be 5,300. It will underestimate. Okay. And if we add the convexity, okay, convexity is basically account for the difference between the price being predicted by the effective duration and the actual change. It accounts for that. It compensates the difference. Okay. Now, that is the reason that for any long position in the bond, you will see that the convexity is positive. For any long position, the convexity will be positive. Now let's talk about portfolio calculations. Usually what happens when you're working, when there is a portfolio, let's say an insurance company is holding a big bond portfolio, they will not invest in a single bond. They will have multiple bonds. Some will be uh, government bonds with different maturities, with different coupon rates and all. Okay, now each of these bonds will have different duration, different DVO1, different convexity values. So how do we calculate the overall duration or overall DVO1 or overall convexity of the portfolio, so that we can hedge for the portfolio altogether rather than hedging for individual instruments separately? Because if let's say your bond portfolio comprises of 50 different bonds, you'll have to put in place 50 different hedges. But if you're able to establish what is the portfolio's DVO1 or portfolio's duration and convexity, you just need to hedge for one position. That's the portfolio position, combined position. Okay. So for DVO1, it's pretty simple. If let's say your portfolio comprises of 3 bonds, A, B, and C, and each of them have these DVO1 values, in order to find the portfolio DVO1, you just need to add them all. 30 plus 40 plus 50. That's the DVO1 of your portfolio. That is 120. Pretty simple. If it is duration, then for duration, we take the weighted average, not the sum, but the weighted average. Why is this difference? Because these are in dollar terms. Okay, so they already incorporate the weight impact. Okay, they already incorporate the weight impact of individual positions. So we just add them. In case of duration, these are the percentage terms. Okay, so they do not incorporate the weight impact. I'll have to take into consideration what are the weights of the asset in the portfolio. Let's say the amount invested in asset 1, 2, and 3 are 1, 2, and 4 million. I can find the weight. It will be 1 over 7. It will be 2 over 7. It will be 4 over 7. Okay, the weights. Then I take the weighted average. It gives me the duration of the portfolio as 8.85%. Okay, so roughly I can say that if the interest rate change by 1%, my portfolio value will change by 8.85%. Okay, that's the interpretation. For convexity, again, I would say it's the same as duration. So for duration, we take the weighted average. For convexity also, we take the weighted average of convexities of each of the bonds. Okay. Now, let's see hedging, duration and convexity based hedging. Now, again, it's a very simple idea. When I was discussing options, I told you that at that point of time that whenever we are hedging, the number of hedging instruments required depends on the number of risk measures that I want to hedge. Number of distinct risk measures precisely. Okay, that so if we were hedging for delta and say let's say gamma and vega and gamma hedging, these were two different risk measures which can be hedged using another derivative. So we were using two hedging instruments, two hedging options, for example, let's say. Okay, in the same way, if we are hedging for duration and convexity, we would require two different hedging instruments to hedge for the position completely. So for complete hedging, if it is only duration based hedging, this will be the relationship. Position is equals to minus of V times dV by dP. Okay, this will be my position. And negative sign indicates the opposite position. So whatever is your existing position, it will be opposite of that. Next, for hedging for both duration and convexity, two bonds will be needed. As I said, two risk measures, two securities, two hedging instruments. Let's say the prices of the two instruments are P1 and P2. Duration of these two instruments are D1 and D2, and convexities are C1 and C2. Okay. Now, let's say my investment has a convexity of CV. First, I'll hedge for duration. So if I want to hedge for duration, it will be P1 D1 plus P2 D2 should be equal to minus of V times dV. Okay, this is my expression, minus of D times V times dV. Now again, this actually feels like it is contradicting the way in which I explained the hedging. I said that, okay, I need to add something in my portfolio in the last class when we were discussing about options, not last class. Okay, I said that when we are hedging for let's say something, so we want to add something in my portfolio so that my net risk exposure becomes 0. And I said that it would be according to my expression, it should be P1 D1 plus P2 D2 plus V times DV should be equal to 0. Again, this expression is nothing different than that. If you just transpose V times dV to the RHS, it will be minus of V times dV. So it's the same thing. So even if you write it like this or the way that I presented, both are correct. Okay, this is for duration. Next, you will account for convexity. It will be P1 C1 plus P2 C2 equals to minus of V times CV. Okay, this is your portfolio. This is your portfolio duration. This is your portfolio convexity. And these are the duration and convexity due to the hedging instruments. Now they should equate in opposite sense so that so that they cancel out one another. Okay, we need to cancel them out. Now we have linear equation in two variables. Two things are not known to us. Okay, first is position in one, second is position in two. That is something I'll calculate. So linear equation in two variables, I require two equations. I have two equations. I'll just put in the value. So this is the value given to me for the I would say for my existing portfolio. Value is $11 million. Duration is 5. Convexity is 20. First hedging instrument has a duration of 3 and a convexity of 15. Second hedging instrument has a duration of 8 and convexity of 30. I just put in place the relevant values. Okay, I have two linear equation in I have two equations with two variables. I solved them. Okay, here I have solved them using elimination method. There are three ways to solve linear equation in two variables: elimination, substitution, cross multiplication. Whatever you guys are comfortable with, you can use. Here I have used elimination. Okay, so when I use elimination, I find that P2 should be equal to minus 5.5 million. In other words, I need to take short position in minus 5.5 million worth of hedging instrument 2. Now I will find P1. I'll substitute again. I'll solve and I find that P1 will be equal to minus 3.67. That means I need to go short in minus $3.67 million worth of hedging instrument 1. Okay, so hedging portfolio will be short $3.67 million worth of bond 1 and short $5.5 million worth of bond 2. My position will be hedged against any large parallel shifts in term structure as well as small parallel shifts in term structure. Now, I'll give you just an instance as to how things happen in practice. Okay, so usually what happens, these are bankers, right? These are in this trade like for some time, and they have really good idea that what's happening in the market and what possibly will happen in the short term. Okay, over the let's say next 6, 7, 8 months period. So what they do, instead of directly going for duration plus convexity hedging, these institutions sometimes only do duration hedging, not convexity, but they monitor it closely. Okay, when do we do this? So let's say they're expecting that in the near future that there will be the change in the yield, but the change will be small. Let's say less than 10 basis point, plus minus 10 basis point. So they will closely monitor convexity, but they will hedge only for duration, saving the cost. Because if they are hedging for duration only, they will require only one hedging instrument, not two. Okay, saving the cost as well as saving the capital. Okay, they will not be required to have to invest more capital in hedging. And if let's say they expect highly volatile markets in the near future, then they will go for both duration and convexity hedging. Okay, so that's how these are decided. So I am saying this because in one of the classes when I was taking earlier, like for actual classes, not the crash course classes, where I used to explain everything in detail, one of the candidates actually asked me that, okay, if duration and convexity hedging is really good, then why do we do only duration hedging sometimes? Why are we studying only duration hedging sometimes? So that is the reason. Sometimes you actually do in practice only duration hedging. And it is true, most of the time you will end up doing duration based hedging, not duration plus convexity hedging. Because most of the time yields, especially for government securities, do not change by large amounts. Okay, especially if it is a developed nation. For developing, it can be a case, but for developed, it's not the case. So there, why would you incur extra cost for the company? You will go for the easiest way possible, correct? And we know that when there are the parallel shifts in term structure which are small, duration-based hedging is a better way, is a cost-saving way. And at the end of the day, you have to decide one thing, that every decision is taken on cost-benefit analysis. Okay, so let's say you're expecting a small changes in term structure and you go for duration plus convexity hedging because it will hedge your profit, it will hedge your portfolio in a really good way. But let's say you don't get the benefit. Let's say the benefit that you're getting, it is overshadowed by the costs. So you won't do that, right? You have to understand that there is always a trade-off. So sometimes we take imperfect decisions just because of this trade-off. Now let's understand barbell versus bullet. So barbell is simply a bullet is simply in making an investment in a single bond. Okay. So let's say you have $1 million and you want to invest it in fixed income securities for 10 years. Okay. So the most natural choice that comes to our mind is I'll invest in a 10-year bond. Okay. That pays me the highest coupon. I'll select that. This type of investment is called bullet. And barbell says, instead of investing in a single 10-year bond, I will select two bonds, one which is maturing before 10 years and one which is maturing after 10 years. And I'll proportionate my money into these two securities and I'll create a portfolio. And I'll keep this portfolio for the next 10 years. Okay, so one would say, why would you do this? If I have a straight way to do something, why would I go for a barbell investment? Okay, so there are certain benefits associated with barbell. Okay, you see, in order to show the benefit, what I will do here, there is an example that you can see that I have 3 bonds. Okay, first, and let's say the plan is to invest for 10 years. Okay, so there are 2 alternatives. First alternative is that you invest directly in 10-year 4% coupon bond. Okay, your value is its price is currently 100. Okay, its duration is 8.1758 and its convexity is 78.8981. Okay, you can invest in this one. Let's say I choose not to invest in 10-year bond, but I invest some of my money in 5-year 2% coupon and 20-year 6% coupon. What is the benefit I'll get? Okay, in order to understand the benefit, let's first calculate the duration and convexity of this portfolio that I have created using 5-year and 20-year bond instead of directly using the 10-year bond. Okay, so let's say I invest an amount W1 or percentage W1 in 5-year bond and percentage W2 in 20-year bond. Weights, again, if W1 is beta, other one naturally will be 1 minus beta because it's a 2-asset portfolio. Now I try to find the weight. So try to find the so you see, the idea is I want to match the duration. Okay, so if bullet investor, what I'm only trying to do is that I'm trying to match the duration. Okay, so for you, since you have invested in 10-year 4% coupon bond, the duration is 8.1758. Now I am investing in 5 and 20-year bond such that for my portfolio also the duration is 8.1758. Okay, so I find the weights. I can find it. I found the weights to be 44% in 56% in 5-year coupon bond and 44% of my money in 20-year coupon bond. Okay, so if let's say I am investing $1 million, so $560,000 in 5-year coupon bond and $440,000 in 20-year coupon bond. Now you would say, okay, Shubham, you did one thing. Okay, so you matched the duration. What's the benefit you got? It's the same now. You see, the benefit comes in the form of convexity. Okay, so now let's calculate duration for the duration for both barbell and bullet is exactly 8.1758. That is as expected because I matched the duration. My portfolio matches the duration with your portfolio. But just if we calculate the convexity of barbell using the weights and all, it turns out to be 107.3824. And the convexity of barbell is actually greater than the convexity of bullet. Okay, so here what is happening? For you, the convexity was 78.89, but for me, the convexity is 107.38. My convexity is greater. It means if I am approximating the change in the price of the bond, or let's say if I go for duration and convexity based hedging, I will have better results. Okay, I will have better hedging results compared to you. Okay, or change in my portfolio value is better approximated than change in your portfolio value. So the idea is, why would I choose it? I asked this question, right? Why would I choose barbell over bullet? Is for the benefit I'll get when I will have to hedge the position. You see, 10-year period is a long period. I'm making an investment for 10 years and I don't want to change my portfolio over this period. So if there is a time of crisis in between, without changing my portfolio, I will be able to better hedge my position compared to a bullet investment. Okay, so that's the benefit that you get out of barbell. Okay, so parallel shifts, if there are parallel shifts in term structure, barbell investment is considered better. As I said, I'll be able to better approximate the changes. In other words, I'll be able to better hedge my position. Okay, compared to a bullet investment. But if let's say you have a non-parallel shift in term structure, then investing in bullet is better. Okay, so depending on the portfolio that you are building, you need to understand that what type of exposure you can expect. Will it be mostly parallel exposure, parallel shift in term structure, or non-parallel? Okay, and accordingly you can take decision to go for barbell or bullet. Okay, now as I said, your investment decision is also not bad. Okay, let's say I created a barbell, you only created bullet, but instead of parallel shifts, there happened non-parallel shifts. That's the problem. Okay, then you will have better outcomes than me. Okay, so that's the end of this lecture. Now just give me a few minutes. I'll just open the next chapter and then we'll start our discussion. Yes, so now let's start with the final chapter of today's discussion. And in fact, with this discussion, we'll be completing valuation and risk models module completely. Okay, so this is the last chapter. And this chapter is VRM 13, that is modeling non-parallel term structure shifts and hedging. Okay, so till now, what we did, we saw that, okay, there are ways to understand interest rate risks and that to hedge against it. But these ways would have worked well if we saw parallel shifts in term structure rather than non-parallel shifts. Okay, but in practice, we do have non-parallel shifts in term structure. And there are multiple reasons that can happen. Let's say an example that I'll give you. So first is flattening, steepening, that is non-parallel shift again. Then you have butterfly shifts where long-term and short-term rates move in one direction, but medium-term rates move in the opposite direction. So that means long-term rates and short-term rates increase, but the medium-term rates decrease. So you will see a structure that will look something like this. Okay, that will look something like this. Okay, so it's a butterfly shift. Again, it's a non-parallel shift. Okay, so how do we capture these dynamics? Because during non-parallel shifts, all these measures, duration, convexity, DVO1 fails. They become inefficient. I would not say they are completely useless. They become inefficient. Now we want our methods to be efficient enough when we are hedging. Okay, we want to get the best out of hedging procedures. So for that, we need to first understand how we model the term structure, non-parallel term structure shifts. And then once it has been modeled, how we hedge against it. Okay, so let's start our discussion. Now, first thing, issues with the single factor approach. You see, in the last chapter, we assumed, in fact, for DVO1 duration convexity, that all the interest rate changes in all the interest rates depend on one factor. Okay, that is usually not true. There are more than one factor which can have an effect on the interest rates. Okay, it does not consider the yield curve risk. So when there is a curve happening, okay, all of a sudden, it does not consider that. Second, it assumes that all the rates depend on a single factor, which again is not true. There are other factors, multiple factors on which the rates might depend. So the best idea is to use the principal component analysis, okay, to find the factors. What are the factors? You see, there can be some meaningful factors, like factors which can have meaning. For example, demand, supply, liquidity, credit risk. These are the factors that have some meaning. We are able to visualize these things. Okay. But PCA, if I say, is a purely statistical technique. Okay, and what it does is that it gives us certain set of factors which may or may not have actual meaning. Okay, that means if I conduct a PCA, principal component analysis, and I'm able to establish that there are three factors which have the most effect on the interest rates. Okay, let's say there are three factors which have the highest effect on the interest rates. Or in other words, the first three factors are lead to a 99% change in the interest rates. So we will be okay with using these three factors for our analysis, okay, as risk factors. Now, what is this first factor? Nothing. It's simply the first factor. What is the second factor? Nothing. It's simply the second factor. What is the third factor? It's the third factor. Okay, simply these are the factors. Okay, so factor one will lead to this kind of change. Factor 2 will lead to this kind of change. Factor 3 will lead to that kind of change. Okay, their actual meaning, it doesn't have. Okay, so here the idea is that the daily term structure movement observed are actually a linear combination of the factors. Okay, example, an observed movement might consist of 5 units of first factor, 2 units of second factor, and 1 unit of third factor. As I said, there are 3 risk factors identified using PCA, and all these factors may not have a name. Okay, what is first factor? Is it demand? Is it supply? Is it credit risk? Is it credit spread? No, it's nothing. It's simply the first factor. Okay, and in order to hedge, we also do PCA for hedging instrument, and we find how the first factor affects the hedging instrument, second factor affects the hedging instrument, third factor affects the hedging instrument. That's all. Okay, that's all what we do. Now, second is that second most important benefit is that after PCA, the risk factors that you get, for example, let's say I find that there are three risk factors, R1, R2, and R3. All these risk factors will be uncorrelated. That means I can very easily assess the impact of each risk factor separately on the bonds or on the interest rates in this case. Okay, so if I'm saying that due to factor 1, interest rate changes by 5 units, it does not mean that other factors, since other factors are uncorrelated, it's an unbiased estimate of the change in the interest rate. Okay, that's second benefit. Third benefit, the first 2 or 3 factors account for the most daily observed movements. Okay, so I'll give you an example. Let's see that example. So let's say you have these many rates to which you have exposure 1 year, 2 year, 5 years, 3 years, 7 year, 10, 20, 30 years. Okay, these are the rates to which you are exposed to. Now, if you will conduct PCA, so basically you can say that there are 8 risk factors to which my portfolio has exposure. Okay, let's say you have 8 zero coupon bonds and each have maturity in 1, 2, 3, 5, 7, 8, 7, 10, 20, and 30. So that means they have exposure to each of these rates. Okay, so these are my risk factors. Now, if you're trying to hedge for these things separately, if you expect that there will be non-parallel shifts in term structure, so you'll hedge for them, you will have to hedge for them separately. That means you will have to initiate 8 different hedges. Correct? When you have non-parallel shifts, combined hedging is not an option. Okay, so you'll have to hedge for 8 different risk factors. So what you do, you conduct the PCA, principal component analysis. After that, you find 8 different risk factors. So number of risk factors in PCA is same as the number of initial risk factors you started with. So I started with 8 risk factors. I end up with 8 risk factors. Okay, but the biggest advantage here is that the first 3 risk factors actually account for the 98% of the risk that the portfolio is exposed to. The first 3 risk factor accounts for the 98% of the risk exposure. Okay, and the remaining 5 together accounts for the remaining 2%. So again, trade-off. As I said, the cost benefit trade-off. Here, you will have to put in place a hedge in order to make your hedging effective. 8 hedges. Okay, in order to make your hedging effective. High cost, high surveillance will be there. It has to be monitored very frequently. Monitoring will be difficult because there are so many hedge positions open. In here, if you hedge for all the 8 factors, you will reduce 100% of the risk. Same as this scenario if you hedge for each of the interest rates. But the catch is, if you hedge only for the first 3, you will hedge for 98% of the risk. Okay, so clear benefit. You are hedging for 98% of the risk by just opening 3 hedge positions. On the other hand, you will have to initiate 8 positions to hedge 100% of the risk. So if you want to increase your efficiency from 98 to 100, your in layman terms, I can say that your what can I say, like your efforts will increase by 5 times actually. Okay, so for each factor, let's say it increases by 1 times. So 1, 2, 3, 4, 5 times. Hypothetically, I'm saying your efforts will increase by 5 times and you will get a benefit of just 2%. Is it justified enough? No. So that's why principal component analysis becomes a very important tool in the case of non-hedging for non-parallel shifts. So what I do, I conduct principal analysis, I find the first 3 factors and I will just hedge for the first 3 factors. I will reduce 98% of the risk in my portfolio. And you see, I am saving the cost on 5 trades. I am saving not just the transaction costs like entry and exit costs. Okay, I am saving capital. A lot of money would have to be utilized in order to hedge for everything. I am saving on the management of these hedges. I am saving on my resources, be it intellectual resources, monetary resources, whatever. Okay, I am saving on all these things. Okay, time, resource, everything is saved. Why? Because now I have to just hedge for only 3. Okay, and it becomes more prominent if you have more risk factors. Let's say in here you had half year rate, 1 year rate, 1.5 year rate, 2.5 year rate, up to 30 years. Okay, so there are 60 risk factors in total. So if you had to hedge, you'll have to initiate 60 hedge positions, manage them frequently every 15 days, resource, manpower, everything will be huge required. But the moment you convert it into the PCA, the moment you employ PCA, maybe if not 3, then at least 4. So just see, from 60 hedges to just 3 or 4 hedges, and reduction of risk 98 to 99%. Okay, so that's the benefit that you get from PCA. Okay, so now instead for hedging for each of these rates separately, we hedge for these first 2-3 risk factors only. End of the story. Okay, now surprisingly, these factors, that is this factor 1, 2, and 3, these are the risk factors, right? Risk factor 1, risk factor 2, risk factor 3. They have some meaning. Okay, you just need to look at the numbers. Here, all the numbers are small, and roughly if you see, especially from 3 year onwards, they are all approximately similar, somewhat small, somewhat high, but they are approximately similar. So what practitioners infer from this is that risk factor 1 accounts for the parallel shifts in term structure. Okay, risk factor 1 accounts for the parallel shifts in term structure. If you will look at risk factor 2 and 3, both of them accounts for the non-parallel shift in term structure. But the difference is, in the case of risk factor 2, it tells us that short-term to medium-term rates are increasing. On the other hand, long-term to short-term rates are decreasing in nature. Okay, it will have a decreasing effect. And factor 3 give us a butterfly effect. Again, it's a non-parallel shift in term structure. So you will hear people saying that factor 1 accounts for the parallel shift, factor 2 accounts for the non-parallel shift, and factor 3 accounts for the butterfly shift. However, non-parallel and butterfly all are the same thing. It's just like saying a quadratic binomial, or like let's say a trinomial and a polynomial. That's the only difference. Both are in a way polynomial only, trinomial and polynomial. Okay, so that's the thing. So this is butterfly shift, and this is simply called the non-parallel shift. And butterfly shift means if you look at the medium to short-term rates, they are moving in one direction, and the long-term rates, short-term and long-term rates are moving in one direction, but the medium-term rates are moving in another direction. Okay, but the medium-term rates are moving in another direction. Okay, that's the takeaway. So here the same thing has been explained, bow-like structure, which is called butterfly structure. Okay. Now let's talk about partial O1s. Okay, that is KRO1, key rate 01, or in other words, it is said key rate exposure. Okay, key rate exposure for 1 basis point increase or decrease in the spot rates. Okay, so usually what happens, like in the curriculum, you will say that there are 3 key rates that has been defined: key rate 1, key rate 2, key rate 3, key rate 011, key rate 012, key rate 013. Okay, which I will call first key rate, second key rate, and third key rate. Okay, 01 should be understood by default. Now, one would say that how do we decide that what will be my key rate? Okay, so in practice, the thing is, it is by tradition in the bank, when you will work for, they will tell you what are the key rates. Second, it is identified through analysis also, that you analyze, okay, which all are the important factors, which are the ones that are most impacted, and those are considered as a key rate. And then what we do, once we have the key rates, let's say key rate 1 is, I say, 2-year key rate. Key rate 2 is 5-year key rate, 5-year spot rate. Let's say I define that first key rate will be 2-year key rate, second key rate will be 5-year key rate, and third key rate will be 10-year key rate. Then what I do, I will consider them as the prime risk factors. And then I will try to estimate what will be the change in other spot rates if these key rates change. Okay, so 2-year spot rate, I am considering it as a key rate. So I would say, what will be the change in 1-year spot rate if 2-year key rate change? Why I'm saying it key rate, now spot rate, why not spot rate? Because I have defined it as key rate. I decided that 2-year spot rate will be key rate. How this decision is made? Sometimes you get it from your seniors if you're working. Sometimes you do analysis, some kind of analysis, and you decide that, okay, this rate will be considered key rates. And it's not always true that, okay, there are only 3 key rates. Depending on the nature of the portfolio, depending on your analysis, depending on what is the practice in the organization that you're working for. Key rates can be many, maybe 3 or 4 or 5, but usually they don't keep more than 5 key rates, because again, you are hedging for these key rates, right? So if you have 5 key rates, you have to put in place 5 hedges. If you have 3 key rates, you have to put in 3 hedges. Okay, so that's the benefit. We need to keep it as low as possible. Now, what does it mean is that, let's say first I define that 2-year spot rate is my first key rate, KR011. So what is the assumption here is that all the rates that are, all the spot rates that are less than, that are all the spot rates for the maturities less than the maturity of the, less than the maturity period of the first key rate will increase by the same amount. So what does it mean is that if my first key rate changes by 1 basis point, my 1 month spot rate, 3 month spot rate, 1 year spot rate, half year spot rate, 1.5 year spot rate, all these spot rate will change by 1 basis point. Basically parallel shift. Then I have to define the next key rate in order to decide this slope. Okay, let's say I decide that the next key rate is 5-year key rate. So in this case, I would say, what will be the impact of 2-year key rate? What will be the change in the 4-year spot rate if 2-year key rate changes by 1 basis point? So again, it is assumed to be linearly decreasing in nature. Okay, this is how it is done. Next, let's define the second. Second is, let's say 5-year key rate. So for 5-year key rate, this is the way in which it affects the surrounding spot rates. Okay, so I'll just give you a very simple example. Let's say 5-year key rate is changes by 1 basis point, and you want to find out what will be the change in the 4-year spot rate because of the change in 5-year spot rate, 5-year key rate. Okay, so you can use the straight line method, right? So this point has a coordinate of 2, 0. This point has a coordinate of 5, 0. This point will have a coordinate of 4, x. You can solve for x, you'll get the value of x. Let's say you get 0.87 or something like that. So you will say, after doing the calculation, you would infer that if the 5-year key rate changes by, or in other words, if my second key rate changes by 1 basis point, my 4-year spot rate will change by 0.87 basis point. Okay, that's how you assess it. Next, let's define the third one. So third one is the final, because after 10 years, I have not defined any other key rate. So beyond 10 years, all the rates are impacted equally. So I would say that if 10-year key rate increases by 1 basis point, 12-year, 14-year, 15-year, 18-year, 18.5-year, 30-year key rate, all the key rates will increase, spot rates will increase by 1 basis point. However, it has a declining effect from 5-year to 10-year period. If we see the complete picture, it looks something like this. Okay, this is the impact of 2-year key rate. This is the impact of 5-year key rate, blue line, and the dark, which color it is? I think it is maroon, dark maroon. It implies the effect of 10-year key rate. Okay, or third key rate. Now, when you combine the effect, you will see that actually it becomes a straight line, because if I talk about this 4-year rate, okay, so 4-year rate is actually being impacted by first key rate also and second key rate also. Due to first key rate, the impact is this, and due to second key rate also, the impact is this. When you add them both, it will turn out to 1. Okay, so if all the key rates are changing, you are hedged for parallel shifts. If some of the key rates are changing, then you are hedged for only those key rates. That means you are also hedged for non-parallel shifts. So if you're hedging using partial O1s, you hedge for both parallel as well as non-parallel shifts. That means it's a better way to hedge. Okay, now let me tell you one thing. DVO1 is simply the sum of all the key rates, key rate O1s. Okay, first key rate O1, second key rate O1, third key rate O1. And it's understandable, because if you combine them together, if you see the complete picture, if you see all the key rates, impact of all the key rates in one graph, it turns out to be all the rates. It turns out that all the rates are changing by 1 basis point. And we have studied in the last chapter that when all the rates change by 1 basis point, it's nothing but DVO1. We are measuring the DVO1. Okay, so that's why it is written that DVO1 is simply the sum of all the key rate exposures. Now let's see how we are going to find the key rate exposures. Okay, so suppose, let's say we have a portfolio which consists of $1 million investment in each of 1 year, 3 year, 5 year, 9 year, and 15-year zero coupon bond. Here we have taken the example of zero coupon bond because it's easy to understand using zero coupons. Okay, so there are not too much calculation to be done. These are zero coupon. So I can say that directly that my risk factors are 1 year spot rate, 3 year spot rate, 5 year spot rate, 9 year spot rate, and 15-year spot rate.
So if I have to hedge for the non-parallel shifts, then I would have to hedge separately for 1 year, 3 year, 5 year, 9 year, 15 year. In other words, I have to put in place 5 separate hedges. Okay. Now, what's the way out? I can use partial key rate exposures to hedge. Okay. Now, again, further information is given that the term structure is flat at 3%. Rates are semi-annually compounded. The decrease in the portfolio value for 1 basis point increase in the relevant spot rates is shown here. Okay. So it is already calculated that if 1 year rate changes by, I would say, 1 basis point, then my portfolio value increases by 1 basis point. My portfolio value decreases by 95.62. Okay. Again, as I said, this example has been taken deliberately so that calculations are easy. If you do the calculation, if you do the maths, and if you apply the theory, you know that 3-year bond, value of the 3-year bond is not affected if and only if 1 year spot rate changes. Okay, because it's a zero coupon bond. And zero coupon bond, 3-year zero coupon bond, price will be affected if and only if 3-year rate changes. It has nothing to do with 1 year change in the 1 year rate. Okay, so the change in the portfolio value because of a one basis point increase in the spot rate happens because of only one security, that is 1 year zero coupon bond. Okay, and the same has been done. So if the 1 year spot rate changes by 1 basis point, my portfolio value decreased by this much. If only the 3-year spot rate changes here, only the 3-year, then my portfolio value decreases by 270. If only the 5-year changes, this, and so on. Okay, now I have 5 risk exposures. If I had to hedge for each one of them, then I would have to introduce 5 hedges. Okay, let's do one thing. Let's calculate the impact of key rates on these spot rates to which I have exposure to. Okay, so I am exposed to 1 year, 3 year, 5 year, 9 year, 15 year spot rates, and I know that my key rates are 2-year spot rate is my first key rate, 5-year spot rate is my second key rate, and 10-year spot rate is my third key rate. Okay, one last thing that I've mentioned to forget here regarding these things was that this 10-year key rate will have impact starting from 5-year onwards. This rates are starting from 5-year onwards. It will have zero impact on the rates below 5 years. Okay, in the same way, if I go back, the 5-year spot rate has an effect or will affect the spot rates for periods starting at 2 years and ending at 10 years. Beyond these two periods, it will have zero effect. Okay, now keeping that in mind, I first need to find out what will be the change in 1 year spot rate if 2-year key rate changes. Okay, if my first key rate changes by 1 basis point, correct? So we have seen that for all the maturities less than 2 year, the change is same as the change in the key rate. So it will be 1. What will be the change in the 3-year spot rate if my first key rate changes by 1 basis point? I can calculate it, that linear interpolation. Okay, that is assuming a line. First coordinate will be 2,1, second coordinate will be 5,0, third coordinate will be 3,x, which is this x. I can then solve for it. I will get 0.6667. So it means if my first key rate changes by 1 basis point, 3-year spot rate will change by 0.6667 basis point. And beyond 5 years, we know that from 5 year onwards, 2-year key rate has no effect. So 0, 0, 0. Okay. Then next, I want to understand what will be the effect of 5-year key rate on the spot rates that I have exposure to. Okay. So for 1 year, zero exposure, because the exposure, the impact of 5-year rate starts from 2 years and ends at 10 years as per our assumption. Okay. So for 1 year, it will be 0. For 3 years, it is 0.3333. For 5 years, it's 1, exactly 1, because if second key rate changes by 1 basis point, and second key rate in itself is a 5-year key rate, so 5-year spot rate will also change by 1 basis point. Then I found the 9-year. For 15-year, it will have zero impact, because after 10-year onwards, who takes over? Third key rate takes over. So zero impact. Okay, but there are certain intermediate periods for which both of them will have impact. Like for 2 and 5-year key rate, 3-year is the intermediate period. On 3-year rate, both 2-year interest key rate and 5-year key rate have an impact, and that impact has been calculated. Next, I do the same for the 3-year key rate, and these are the calculations. Now my job is to find out the key rate exposure rather than the individual exposure for each rates. So it will be 1 basis point change, okay, due to 1 year key rate. So this was my exposure. And what is the change due to second year key rate? 1 basis point. Plus second key rate is changing by 0. Second spot rate is changing by 0.6667 because of the first key rate. And my exposure amount is 270 plus this amount, and all other spot rates are unaffected. So exposure due to first key rate will be 275.80. Similarly, I'll do the calculations for others, and I get now 3 risk exposures instead of 5. Initially, I had 5 exposures. Now I have 3 key rate exposures. Okay. Now I require only 3 hedging instruments, not 5 hedging instruments. I will hedge for first key rate, second key rate, and third key rate. End of the story. By doing so, I am hedged for both non-parallel as well as parallel shifts in term structure. Okay. So when I add them all, this will give me the DVO1. That means all the rates are changing by 1 basis point, 2412.80. That's my DVO1. But here I am not hedging for DVO1. Rather I am hedging for component DVO1, or you can say key rate O1s, like key rate exposures. Okay, so these are my key rate exposure components of DV01. Now let's take a different example. So here the calculations have already been done. Now from the examination perspective, what they will say, they will ask you, either they will ask you to find the key rate exposures pretty easily, or they will give you this whole information that what is the key rate exposure of hedging instruments and the key rate exposure of portfolio. Find out what should be the hedge position. Okay, how much money should be invested in hedging instrument 1, 2, and 3. Again, since you have 3 exposures to hedge, first key rate, second key rate, and 3 key rates, that's why you have 3 hedging instruments also. Okay, now let's see again. Let's position is x1, x2, and x3 in hedging instrument 1, 2, and 3. So first will be 20x1 plus 3x2 plus 3x3 should be equal to minus 126. Second equation will be 2x1, 22x2, 4x3 equal to minus 238, and so on. Okay, so you have the 3 statements written. Okay, it should be 385. Okay, this is wrongly written. Third one, it will be 385. Okay, now when we solve these 3 sets of linear equation in 3 variables, of course, it's a lengthy process, can be solved. First, what you will do, you will find a relationship in x1 and x2. So you will find one of the values and replace it in other 2. You will get 2 equations in linear equation of 2 variables. Okay, then you will solve these 2. You will get x1 and x2 and x3, let's say, for example, or x1 or x2, whatever you are solving. And then finally, you will use it to get the third value. You find that x1 is minus 3, x2 is minus 8, and x3 is minus 14. Minus sign indicates that you will have to take negative positions or short positions. Okay. Next is bucketing approach. Now, bucketing approach is similar to key rate approach. Okay, with one slight difference. Okay, the difference is in key rate approach, we assume that as we move forward in time, the effect of first key rate actually declines. Okay, and then the effect of second key rate actually increases during that time. Okay, so there is a decline and increase happening. So for every period spot rate, if you want to estimate the change, you will have to use linear interpolation to find it. That adds to complexity. A way out here is bucketing approach. So here what you do, you identify that certain rates I'll keep in one bucket, bucket 1, bucket 2, and bucket 3. So let's say you decide that all the rates up to maturity of 2 years will be considered in bucket 1. All the rates from maturity between 2 to 10 years will be considered bucket 2, and all the maturities, spot rates for maturities beyond 10 years will be considered bucket 3. Okay. Now here also you are considering 3 different segments, and you hedge for each one of the buckets. That's a slight variation, and in each bucket, the idea is that we don't have to utilize linear interpolation. Rather, what we assume is that if in bucket 1, I assume that there will be an increase of 1 basis point, then all the rates in bucket 1 will increase by 1 basis point. So by my bucket 1 actually comprises of 6-month spot rate, 1 year spot rate, 1.5 year spot rate, and 2 year spot rate. So all these rates will increase by 1 basis point. If I say my bucket 2 increases by 1 basis point, it means all the rates that we have from 2.5 years till 10 years will increase by 1 basis point. So within one bucket, we have a parallel shift. Okay, within each bucket. Okay, but it does not mean that all the buckets will have a parallel shift. Okay, all the buckets are changing at the same time. It's possible that in bucket 1 you have a positive change, in bucket 2 you have a negative change, in bucket 3 you have a positive change. Okay, so you'll have to hedge accordingly. That's a non-parallel shift. Duration will fail. Bucketing approach can help you. Okay, and more precise way, even a precise way than bucketing approach is KRO1. Okay, but it has its own limitation because it assumes linear interpretation, a linear relationship, that the effect is either linearly increasing or linearly decreasing. That's not true, in fact. Okay, sometimes. So I define first bucket B1. As said, in this bucket I have all the rates which are between 0 to 2 years. Okay, second bucket B2, which have years, all the years between 0 to all the interest rates between 2 years to 10 years. Okay, and then finally bucket 3, which includes all the interest rates from 10 year onwards. Okay, or 10 year to 30 years. Okay, that's my buckets, 3 buckets. Now within each bucket, all the rates will change by same basis point. So if I said 12-year rate changes by 1 basis point, all other rates will change by 1 basis point in this bucket only. Okay. And again, I would say that, okay, if 9-year rate changes by 1 basis point, what will be the effect on 12-year rate? No effect. Okay, because 12-year rate does not fall in the bucket in which the 9-year rate is. 9-year rate is in the bucket called bucket formed using 2 to 10-year rates. Okay, so that's the idea. Here also, if you add all the bucket ones, the risk exposure for bucket 1, bucket 2, and bucket 3, it will turn out to DVO1. Again, you can understand, you just combine all these 3 buckets. Okay, this is 10 and above, 10 and beyond. Now, this is 2 to 10. And this is 0 to 2. Okay, so you see, what you see is a straight line parallel to x-axis starting at 1 basis point. So basically, you end up measuring DVO1. Okay, DVO1 is also the sum of bucket 1, bucket 2, and bucket 3. Now, depending on how complex you want your model to be, you can decide on whether to go for KRO1 approach or bucketing approach to hedge against. Okay, if I talk about duration measures, duration is given as we have seen in the last chapter. It is 10,000 times DVO1 divided by value of portfolio. In fact, this formula is true to find out duration using any partial O1 measures also. Okay, partial O1s like KRO1 or bucket O1s. Okay, any O1 measure can be used. So in general, you can say duration can be given as 10,000 times any O1 measure divided by the value of the portfolio. Okay, now the catch here is that DVO1 accounts for all the rates. But if I say partial first O1 measure, first KRO1, okay, it's only a part. I'm not considering second and third. So what you will have to do, so what you end up calculating here is that partial duration. So in order to get the actual duration of the bond, you will have to use this formula for all the KRO1s. Okay, so let's say your first KRO1 is 250 for first KRO1. So you will write 10,000 times 250 divided by the value of the portfolio. The second KRO1 is 540. You will write 10,000 times 540 divided by the value of the portfolio. Third KRO1 is 900. You will write 10,000 times 900 divided by the value of the portfolio. And then whatever the results are for the 3 expressions that you have solved, just add them together. That will give you the overall duration of the bond. Okay, if you just consider a single partial O measure, you end up calculating the partial duration. Okay, in other words, that interpretation would mean change in the price of the bond if rates for the period of 0 to 2 years change by 1 basis point. A way of saying it. Okay, other rates are simply ignored. So that's partial duration, right? So you have to change accordingly, okay, in order to get to the duration. So with this, we have completed the chapter and our discussion for the day. I hope you guys were able to understand the concept properly. And as I said, these chapters were lengthy, so it took a little longer. We had to sit for almost like 4 hours, something like that. Okay, so yeah, next classes we will get the time. You will get the timings and the schedule, what all will be done. So till then, have a good day. Prepare hard. All the very best for your exam. Bye bye.